A lot of people think living off dividends requires huge amounts of money. In reality, it can start with something as simple as a $7 or $9 single-digit daily investment, if it's put to work the right way. The truth is, the best way to build lasting dividend income comes down to having the right strategies and then sticking with them over time. Over the past year, I've shared dozens of videos breaking down exactly how to create a portfolio that can pay real, life-changing income. So, in this special compilation, I've pulled together the most practical and most powerful strategies all in one place. I will show you why just 4 ETFs might be all you need to stop overthinking investing, which single ETF could be the best pick for 2025, how to calculate the exact amount you need for $2,800 in monthly dividends, and why most investors miss out by only using one type of compounding. And to round it out, beginner strategies to grow $500 into real wealth, and how new tax laws could turn dividend ETFs into gold mines. By the end, you'll see the clear, repeatable approach I use to build dividend income step by step. Let's kick it off with the basics. What if you could build a portfolio that pays you over $2,800 a month in passive income, or grows into nearly $1 million, all while investing less than the price of lunch each day? Sounds impossible? It's not. Most people make investing way harder than it needs to be. They chase hot stocks, follow random tips online, or try to time the market, and almost always end up stressed, second-guessing, and underperforming. But what if building wealth didn't have to be that complicated? What if just 4 ETFs, yep, 4, could give you everything you actually need for long-term growth, passive income, and peace of mind? I call it the wealth quadrant system, and once you understand how it works, you'll see why it's such a game changer. In this video, I'm going to walk you and Josh through the entire wealth quadrant system, step by step. You'll see how just 4 ETFs can give you full market exposure, protect your portfolio from downturns, drive massive long-term growth, and one of the ETFs even generates over $200,000 a year in passive income. In the end, I'll show you how to combine an ETF from each quadrant and build 2 complete portfolio strategies. One for income that pays over $34,000 in annual dividends, and one for growth that can reach close to $1 million valuation, all while investing just $9 a day. But before we dive into the 4 ETFs themselves, let's break down the system behind it, and why this approach could finally give you the clarity and confidence you've been looking for. Imagine trying to build a house without a plan. You might get a few walls up, maybe even a roof, but without structure, it won't hold up. Your portfolio works the same way. It needs a solid blueprint, one that balances strength, growth, cash flow, and future potential, without leaving you guessing. That's what the wealth quadrant system is all about. It breaks investing into 4 key needs: a strong foundation, consistent resilience, high-powered growth, and reliable income. Each of these plays a different role, and when they're all working together, your portfolio stays balanced, steady, and ready for anything. Let's break that down a little more. First, you need a foundation, something that gives you exposure to the entire market. Big companies, small companies, every sector, not just the popular ones. This gives your portfolio natural balance and spreads out your risk without you having to think about it. Then comes resilience, the layer of large dominant companies that have been through cycles, crashes, and comebacks. These are the businesses that hold steady when things get rocky and keep pushing forward when the market runs. Next, there's growth, the engine that pushes your portfolio further. These are the companies investing in innovation, expanding fast, and chasing the future. They're more volatile, sure, but they also bring the potential for serious upside. And finally, income, the cash flow that keeps things moving even when the market doesn't. These are companies that pay you just for holding them, and when you reinvest that income, that's where the compounding magic really kicks in. To make it even easier to track, I'm going with ETFs. Now you might say, why ETFs and not individual stocks? The answer to this is simple. It's instant diversification, instant balance, and it cuts out the guesswork. There are ETFs that cover the entire market, others that focus on specific sectors like tech or energy. Some are built for income, some for growth. But the point is, you're not putting all your eggs in one basket, and you don't have to watch the market like a hawk to keep up. Now, if ETFs are so great, why do so many people still feel overwhelmed? Because there's too much noise. Online, you'll hear 1,000 different opinions: growth versus value, small cap versus large cap, dividend versus momentum. Every influencer has a different strategy, and suddenly you've got 20 tabs open, comparing charts, wondering if you're already too late. That's analysis paralysis, and it's more common than you think. So here's a better way. Instead of trying to outsmart the market, you build a portfolio of 4 time-tested ETFs. They're diversified, they're proven, and they're designed to work together. That way you stop second-guessing, stop reacting to every headline, and finally get what most investors are missing: peace of mind and a clear plan you can stick with. And once you have that clarity, you'll also be able to spot the traps that most people fall into, like chasing big dividends or trying to pick the next breakout stock. Let's talk about why those strategies so often backfire. The dream of living off dividends, getting paid while you travel, relax, or just live your life, sounds amazing, but most people overestimate the income and underestimate the risk. High-yield stocks might flash big numbers, 6%, 8%, even more, but usually there's a reason. Maybe the stock price tanked, maybe the business is struggling, and if profits dip, that juicy dividend can vanish overnight. Even if it doesn't, a sinking stock price can wipe out the value of your investment. Then there's stock picking. Everyone wants to find the next Tesla or Apple before it explodes, but even the pros, with full teams of analysts and all the data in the world, still fail to beat the market consistently. For regular investors, it's like throwing darts blindfolded. You might hit a winner once in a while, but more often than not, you miss, and one bad pick can wipe out the gains from 5 good ones. That's why ETFs exist. They let you own the winners, avoid total wipeouts, and grow steadily without betting your future on a single stock. Now here's the smart part. Each ETF we're about to look at fits perfectly into one of these 4 wealth quadrants we saw a minute ago: foundation, resilience, growth, income. And together, they don't just balance each other, they actually make each other stronger. I'm not throwing darts here, we're building something with purpose. And it all starts with the foundation, an ETF that gives you ownership in thousands of companies across the US economy, all in one simple move. And that is Vanguard Total Stock Market Index Fund ETF shares with a ticker symbol VTI. This ETF is like buying a tiny piece of nearly every company in America all at once. It holds over 3,600 different stocks, covering everything from tech giants to small-town manufacturers. Big players, small caps, every sector, it's all in there. This is your foundation because it doesn't try to predict winners. It just owns the whole field. And that kind of exposure means you don't have to worry about which sector is hot or which trend is fading. When tech is down, maybe healthcare is up. When large caps stall, small caps pick up the slack. It's built-in balance, and that's exactly what a solid foundation should give you. At the top of the fund, you'll find names that dominate the global economy. Apple with 6.19%, Microsoft 5.17%, Nvidia 4.66%, Amazon 3.36%, Meta 2.34%, Berkshire Hathaway 1.75%, Alphabet 1.67%, and Tesla 1.31%. These are household names with deep economic moats, and they make up a sizable chunk of VTI's exposure. But beyond that, you're also holding thousands of mid-cap and small-cap companies, the next generation of market leaders in the making. That kind of breadth brings built-in balance. When tech cools off, financials or healthcare might step in. When large caps slow down, small caps can take the lead, and through it all, you stay invested across every twist and turn. Now let's talk numbers. In the past year alone, VTI returned 11.27%, which includes both price gains and dividends. Its 5-year total return sits at 95.86%, and across 10 years, it has grown by 154.73%, more than tripling an investor's money. All this is done with an ultra-low expense ratio of just 0.03% in the industry. That's free, which means more of your returns stay with you. VTI has a current dividend yield of 1.37%, a dividend growth rate of 6.73%, and an average annual share price appreciation of 9.73%. Now, if you or Josh, let's say, invest $9 a day into this ETF, after just 1 year, you would have invested around $3,285. But stay the course, and by the 10-year mark, that number grows to approximately $55,000. Keep going for 20 years, and your investment would reach $204,000. And if you're truly playing the long game, 30 years of consistent contributions and reinvested dividends, you're looking at an impressive portfolio worth about $600,000. By then, your yearly dividend income would hit $3,100. That's why VTI is your foundation. It's broad, it's boring in the best way, and it's always working steadily over the long run. Now, foundations are great, but you also want something with more focus, something that locks in on the biggest, strongest companies and gives you resilience when the market gets shaky. That's where the next piece of the quadrant comes in: resilience. In the end, I'll show you how to combine an ETF from each quadrant and build two complete portfolio strategies, one for income that pays over $34,000 in annual dividends, and one for growth that can reach close to $1 million valuation, all while investing just $9 a day. Back to the quadrant system. For resilience, I have Vanguard S&P 500 ETF, or VOO. VOO tracks the S&P 500, a collection of America's 500 biggest and most profitable companies. These are firms with solid earnings, dominant market positions, and a long history of pushing the economy forward. When you invest in VOO, you're not just betting on the market, you're backing the leaders of it. VOO gives your portfolio a layer of strength. These companies aren't just surviving, they're leading. They've been tested through market crashes, recessions, and rallies. When the economy dips, these are the ones still hiring, still innovating, still paying dividends. It's this kind of stability that gives your portfolio resilience, that ability to take a hit and keep going. You're not gambling on trends here, you're backing the giants. Let's talk about who you actually own inside this fund. VOO's top holdings are a lineup of giants: Apple with 7.03%, Microsoft 5.58%, Nvidia 5.59%, Amazon 3.78%, Meta 2.66%, Berkshire Hathaway 2.06%, Alphabet 1.9%, Broadcom 1.65%, and Tesla 1.53%. Together, these companies make up over 33% of the ETF, meaning this fund leans hard into the names that are shaping technology, finance, and the future of the economy. That means VOO gives you powerful exposure to technology, healthcare, consumer, and finance without you having to pick individual stocks or time the market. It's automated, diversified, and ruthlessly efficient. And the numbers to back it up: over the past 1 year, VOO returned 12.19%. Over 5 years, it's up to 99.81%. And over 10 years, it is compounded by an impressive 168.52% in price return alone. And speaking of dividends, VOO currently yields 1.36%, distributing about $6.70 per share annually with a 0.03% expense ratio. That means you're getting elite exposure at nearly zero cost. It's efficient, stable, and built to compound over time. Also, it increases those dividends by 6.56% on average each year, and to top it off, it has an average annual share price appreciation of 10.32%. Now, let's break down if you started investing $9 a day into this ETF. Your portfolio at the end of the first year would be valued at $3,285. Simple enough. But fast forward, and by year 10, it would grow to $56,000. By year 20, it's projected to reach $216,000. And after 30 years, you'd be sitting on approximately $659,000. Out of that, more than $530,000 would come from price appreciation, with another $31,000 from reinvested dividends, making $561,000 total value added to the portfolio. By that time, you'd be earning about $2,700 annually purely from owning one ETF. What makes VOO such a powerful complement to VTI is that it sharpens your exposure. Where VTI gives you everything, VOO leans into the winners, and that extra focus can give your portfolio more staying power in tough markets. But resilience is just one side of the story. Now that we've got the foundation and strength in place, it's time to turn up the heat. Let's talk about what drives serious portfolio growth and how the right ETF can supercharge your long-term returns. For this, I have iShares Russell 1000 Growth ETF with a ticker symbol IWF. This ETF focuses entirely on growth, not slow and steady, but fast-moving, high-conviction innovation. It tracks the Russell 1000 Growth Index, which means it holds large-cap companies that are aggressively reinvesting in themselves, building new products, expanding into new markets, and leading the future in tech, healthcare, and beyond. IWF holds the big names like Apple, 11.24%, Microsoft 10.6%, Nvidia 9.24%, Amazon 6.42%, Meta 4.03%, Alphabet 3.44%, Broadcom 3.26%, Tesla 3.09%, and Eli Lilly 2.7%. These companies are the innovators, the disruptors, and they're not sitting still. They're driving digital infrastructure, artificial intelligence, cloud computing, and next-gen healthcare. More than half of the fund is concentrated in these top 10 companies, so it's definitely more aggressive than VTI or VOO, but intentionally so. IWF is designed to tilt your portfolio toward innovation and future potential. That concentration isn't without risk, but it's exactly what gives IWF its edge. Over the past 10 years, its price return has been 273.68%, which means the share price has nearly quadrupled. Over 5 years, the price return is 122.14%, and in just the past year, it's up 15.75%. That's not just strong, it's elite performance in the growth ETF space. Even during turbulent stretches, IWF has shown resilience, bouncing back and continuing to climb. If you're looking for long-term appreciation driven by cutting-edge companies, IWF checks that box decisively. It doesn't pay much in income, the current yield is just 0.48%, but this fund isn't about dividends, it's about scale. It's for people who understand that wealth isn't built from cash flow in the early years, it's built from appreciation, then converted to income later. IWF has a current dividend yield of 0.48%, a dividend growth rate of 3.21%, and an average annual share price appreciation of 14.03%. So what happens if you invest $9 a day in this ETF? After 1 year, you would have invested $3,285. That's your initial seed, but give it time and watch what happens. In 10 years, that same consistent investment would grow to about $64,000. Stick with it for 20 years, and you'd be looking at nearly $305,000. And if you stay the course for 30 years, your portfolio would climb all the way to around $1.2 million. What's incredible is that almost every dollar of that growth comes from capital appreciation, not income. And that's the point. IWF adds a forward-leaning, fast-moving layer to your wealth quadrant. It brings scale and ambition, and it pushes your long-term returns further than stability alone ever could. But it has its risks as well. In the end, I'll show you how to combine an ETF from each quadrant and build 2 complete portfolio strategies which reduce risk and still have the potential to reach close to $1 million valuation. IWF is high growth, and high growth often means low income. And not everyone wants to wait decades for their portfolio to start paying them back. That's why the next ETF is here, to deliver real, reliable income now and help you build cash flow you can count on. And checking the income quadrant of your portfolio, for this quadrant, I have Schwab US Dividend Equity ETF with a ticker symbol SCHD. If there's one ETF in this portfolio that truly earns the label cash flow machine, it's SCHD. While IWF brings speed and VTI brings scale, SCHD delivers steady, rising income with a complement to a rock-solid foundation. This ETF is all about one thing: consistent, growing cash flow. And unlike high-yield funds that chase risky payouts, SCHD is built on quality. It only holds companies with strong balance sheets, solid cash flow, and a proven history of rewarding shareholders. These aren't flaky high-yield traps, they're real businesses with staying power. What makes SCHD different is its strict selection process. To be eligible, a company must have a market capitalization of at least $500 million, a minimum average daily trading volume of $2 million, and a history of paying dividends for at least 10 consecutive years. Once these criteria are met, the fund evaluates companies based on 4 equally weighted factors: free cash flow to total debt ratio, return on equity, indicated annual dividend yield, and 5-year dividend growth rate. This comprehensive approach ensures that only financially robust companies with a strong commitment to returning value to shareholders are included. The final portfolio comprises 100 stocks, with individual holdings capped at 4% to 5% and sector exposure limited to 25% to maintain diversification. This meticulous selection process aims to provide investors with a stable and growing income stream, making SCHD a compelling choice for those seeking reliable dividend income. Inside the fund, you'll find companies like Coca-Cola holding 4.44%, Verizon 4.41%, ConocoPhillips 4.3%, Lockheed Martin 4.28%, Home Depot 4%, AbbVie 3.95%, and Amgen 3.94%. These are firms that have weathered economic cycles and kept rewarding shareholders through it all. SCHD is diversified across sectors, with heavy weightings in consumer defensive, energy, healthcare, industrials, and financials. These industries tend to hold up well during economic downturns, which is why SCHD often performs with surprising resilience. And the numbers back it up. Over the past 1 year, SCHD returned 1.18%. Over 5 years, it's up 58.52%. In over 10 years, it is compounded by an impressive 94.43% in price return alone. And speaking of dividends, SCHD currently yields 4.04%, distributing about $1.04 per share annually with a 0.06% expense ratio. That means you're getting high-quality dividend exposure with almost no drag from fees. It's efficient, income-rich, and built to do one thing extremely well: pay you year after year. It also has one of the most solid dividend growth histories thanks to its strict selection process. Its dividend growth rate stands at a sound 11.3%, and from the price history, you get an average annual share price appreciation of 6.83%. Now, let's look at what happens if you commit to it long term. If you invested $9 a day into SCHD, your portfolio could grow to nearly $58,000 in 10 years. After 20 years, that number would hit around $291,000. And by year 30, you're looking at a portfolio worth approximately $1.69 million. And since it's a dividend-focused ETF, by the 30-year mark, it will be paying around $200,000 a year in dividends alone. That's over $16,600 per month, all from reinvested cash flow that kept compounding year after year. More than $1,008,000 of that total value would come just from reinvesting those dividends, and $588,000 from capital appreciation, adding total value to the portfolio of $1,596,000. SCHD doesn't chase moonshots. It's not trying to double overnight, but it delivers something that's just as powerful: stability, sustainability, and the kind of income that can give you financial freedom. Now you have an ETF for foundation, resilience, growth, and income. But here's the thing: depending on what stage of life you're in or what kind of investor you are, there's more than one way to use this setup. You can take the same building blocks and shift the weight to match your goals. Some people want their portfolio to start paying them sooner. They're thinking about income, maybe even early retirement. Others are laser focused on growing their money as fast as possible and letting it compound for the long haul. So let me show you two real strategies you can use with these same ETFs. One is all about dividend income, the other leans hard into growth. Both are smart, both are simple, and both are built with purpose. Let's start with the dividend-focused portfolio. This one is designed to pay you back with real income when you retire. This portfolio is for investors who love the idea of getting paid to own great companies. It's built to generate solid cash flow, but still give you long-term growth. You're not just collecting checks, you're growing your wealth too. So here's how you set it up. You'd put 70% of your money into SCHD. That's the workhorse, a high-quality dividend ETF filled with companies that don't just pay dividends, but keep raising them. Then you have the remaining 30%, 10% each to VTI, VOO, and IWF. That gives you full market coverage, large cap stability, and a little extra growth potential, without overcomplicating things. Now let's talk about how we figured out the income this portfolio can actually produce. It's not guesswork, it's math. I looked at the dividend yield of each ETF in the portfolio. So, SCHD might be paying around 4%, while VTI is closer to 1.3%, VOO about the same, and IWF under 0.5%. Then, based on how much of the portfolio each one takes up, I calculated the average, but not a simple average, a weighted one. When we run those numbers, the overall dividend yield for the whole portfolio comes out to about 3.15%. Okay, let's break this down like we're figuring out how to calculate your portfolio metrics when you don't invest equally. In your dividend-focused portfolio, SCHD makes up the biggest chunk, 70%, while VTI, VOO, and IWF each make up 10%. Now, each of these ETFs has its own flavor when it comes to dividend yield. SCHD has a strong one at 4.04%, while the others are much lighter. VTI is 1.37%, VOO is 1.36%, and IWF is just 0.48%. If you just added those numbers up and divided by 4, you'd get a simple average, but that wouldn't make sense here. You're not putting equal amounts into each one, you're putting way more into SCHD, so its impact should be way bigger in the final number. So here's what you do instead. You multiply each ETF's dividend yield by how much of the portfolio it represents. For SCHD, that's 70% or 0.7 times 4.04%, which gives us 2.828%. Then we do the same for the others. 0.1 times 1.37% equals 0.137%, 0.1 times 1.36% equals 0.136%, 0.1 times 0.48% equals 0.048%. Now we just add all of those up. 2.828 plus 0.137 plus 0.136 plus 0.048 equals 3.15%. And that's your real total dividend yield for the whole portfolio. I did the same kind of thing for dividend growth, looking at how quickly each ETF has increased its payouts over the past decade. SCHD's been crushing it with over 11% annual growth. VTI and VOO have been solid too, and even IWF contributes, though it's more of a capital appreciation play. When you weigh those based on how much each ETF contributes to the mix, you get a dividend growth rate of about 9.56% per year. Now here's where it gets exciting. I ran the numbers on what this portfolio could become over time, assuming you invest $9 a day every single day and reinvest all the dividends back into the portfolio. After the first year, you'd have about $3,285 invested. Stay the course, and by year 10, you're looking at $57,000. 2 decades in, and it will grow to $234,000. And if you stick with it for 30 years, you will be sitting on $826,000. By that 30th year, this portfolio would be paying you about $34,100 every single year. That's over $2,800 a month. If you add it all up, the capital growth plus all the reinvested dividends, you're looking at a total value added of $727,500 over those 3 decades. About $476,500 comes from price appreciation, and the rest, a solid $251,000, is from reinvested income. But let's say you're not looking for income right now. Maybe you've got time on your side, and you're in full growth mode. You're not thinking about cash flow yet. You're focused on building a big, powerful portfolio that can give you options later. That's where the growth-focused portfolio comes in. This one's built for people who aren't worried about income today. Maybe you're in your 20s, 30s, even 40s, and you're thinking long-term. You've got time. You want that snowball to get as big as possible before you start living off it. So instead of focusing on dividends, this portfolio leans into fast-moving, high-growth companies. You're still diversified, but the goal here is simple. Grow your money as much as possible, as fast as possible, with smart, broad exposure. Here's how that setup works. You take 70% and put it into IWF. That's your high-growth engine. Then, to keep things balanced, you add 10% into VTI, 10% into VOO, and 10% into SCHD. VTI gives you a piece of everything in the market. Just like for the dividend growth, you can find the investing metrics for the growth portfolio using weighted average metrics. If you allocate investment this way, the overall portfolio will still have a yield. It's just low, around 1.02%. And that makes sense. This portfolio is focused on appreciation, not income. Same goes for dividend growth. Since we're not building around SCHD this time, the average growth rate is lower, about 4.71% a year. It's there, but it's not the priority. Where this strategy really shines is in share price growth. When you look at how fast these ETFs have grown in value, especially IWF, the numbers are seriously impressive. Weighted together, this portfolio's average annual price appreciation is around 12.51%. That's where the firepower comes from. So let's run the same $9 a day scenario and see what this thing can do over time. After year 1, just like before, you would have gotten $3,285 invested. But hang in there, and by the 10-year mark, you will already surpass the dividend-focused portfolio, valued at around $61,000. Stay consistent, and by year 20, you would hit $264,000. Push all the way to 30 years, and this portfolio could grow to around $927,000. That's nearly $1 million portfolio. And remember, that's without chasing high yields or trying to time the market, just consistent investing, reinvesting everything, and letting the math do its thing. Now, the dividend income from this strategy? It's not much. By year 30, you're getting about $794 a year. That's around $66 a month. But that's the trade-off. You're not collecting big checks today. If you look at the total value added over those 30 years, it's even bigger than the dividend strategy. You're looking at $829,000 in total gains, with $817,000 of that coming purely from price growth. Only about $12,000 came from reinvested dividends. It's a totally different approach, but the logic is just as sound. Now the real question becomes, which of these feels more like you? Because neither is better or worse, they're just different tools for different goals. And once you know what you're aiming for, choosing the right one becomes a whole lot easier. Most people invest in ETFs that sound smart. Big names, solid track records, all the usual boxes checked. But here's the thing, over time that pretty good pick, it can quietly cost you $500,000 and over $70,000 in lost dividends without you even realizing it. So here's what we're doing. I have taken 5 well-known ETFs, one you've probably seen mentioned a dozen times, and lined them up side by side. I am taking into account total returns, dividend income, fees, risk, everything that actually matters over the long haul. Now, some of these ETFs are solid, but one of them, it stands out by a mile. I'll show you and Josh exactly why later in the video. And at the end, I'll compare all the ETFs to show how a $7 daily investment in the best one could add an extra $500,000 to your portfolio and pay over $70,000 in annual dividends. Before we get into how I actually picked the top ETFs, let's just make sure we're all on the same page with what an ETF even is, because once you understand the basics, everything else starts to click. So, think of an ETF like a shopping basket filled with stocks. Instead of buying one company at a time, you're buying a whole group in one shot. And just like a regular stock, you can buy or sell it throughout the day on the stock market. Super simple. Some ETFs are built for growth, meaning they invest in fast-growing companies that are trying to get big fast. Others are built for income. They focus on companies that pay out steady cash in the form of dividends. But the kind we're focusing on in this video? Dividend ETFs that do both. They give you cash in your pocket today and a chance for long-term growth down the line. Now here's where it gets interesting. Not all dividend ETFs play the same game. Some stick with big, stable companies that have been paying dividends for decades. Others go after undervalued or higher-yielding sectors like utilities and banks. Each one comes with a different balance of risk and reward. That's why understanding how each one is built and what it's aiming to do is a big deal when you're trying to figure out what fits your plan best. And that's exactly what we're about to do. Break down how I'm comparing these ETFs so you can actually see what matters and what's just noise. So, before we rank anything or compare numbers, let's talk about the actual criteria I'm going to use to select these ETFs, because not all funds are created equal. 2 ETFs might look similar on the surface, both paying dividends, both owning well-known companies, but when you zoom in, the differences can be massive. Here's what matters. First, I'm looking at total return, not just the share price growth, but the combination of growth plus dividends over time. This is what impacts your wealth, especially if you're reinvesting those dividends year after year. Then there's the dividend yield. Basically, how much cash you're getting back every year compared to what the fund costs. But yield alone isn't enough. We also want to see dividend growth. Is that payout increasing year over year or staying flat? Then comes risk. Every ETF carries some risk, but I'll be looking at how volatile each fund is, how it performed during down markets, and whether it tends to bounce back quickly or stay down longer. Another biggie is the expense ratio. This is the fee you pay to hold the fund, and over decades, even small differences can cost you thousands. Lower is almost always better. And finally, there's the quality of the companies inside the ETF. Are we looking at strong, steady businesses with real profits, or risky businesses with shaky track records? These are the filters I'll use to cut through the noise and figure out which ETFs are worth your money, not just today, but for the next 10, 20, even 30 years. Now let's look at our first pick, one that often tops the charts for long-term stability and performance. SPDR S&P 500 ETF Trust with a ticker symbol SPY. This ETF is one of the most popular and widely traded in the world. Launched back in 1993, SPY was the very first ETF listed in the US, and it's still going strong. What it does is super straightforward. It tracks the S&P 500, which means when you buy SPY, you're instantly investing in 500 of the largest companies in America. With just one investment, you're getting a broad slice of the American economy: tech, healthcare, finance, and more. Known for its low cost, high liquidity, and strong long-term performance, SPY is a core choice for investors seeking steady, diversified growth. And the performance? It speaks for itself. Over the past year, SPY is up about 12.77%. Zoom out to 5 years, and it's gained around 95%. Go even further, over 10 years, and you're looking at a 201.94% return. That's not just good, that's elite. You'd be hard-pressed to find another fund that has delivered that kind of long-term steady growth. Now, one reason people love SPY is the low cost. Its expense ratio is just 0.09%, which means you're barely paying anything in fees. And that matters because the less you pay, the more of your money stays invested and keeps growing. That said, its dividend payout is $7.17 per share. So while this fund isn't built to maximize income, it's a powerhouse when it comes to capital appreciation. Investors looking for total return through both price growth and dividends will appreciate the blend this ETF offers. And it's massive, $645 billion in assets. That kind of scale means it's super liquid with tight spreads and efficient trading. It's easy to get in and out without losing money to friction. As for its holdings, you're buying into a basket of America's biggest and most influential companies: Nvidia, Microsoft, Apple, Amazon, Meta, Tesla, Alphabet, and more. Technology makes up a dominant 35.01% of the portfolio, followed by financials, consumer cyclicals, and communication services. This reflects the modern economy's digital core and positions the ETF to ride trends in AI, cloud, and software. Now, when it comes to risk, SPY actually holds up pretty well. It has a standard deviation of about 12.6, and if you're wondering what that means, think of standard deviation as a way to measure how much an investment jumps up and down in value. The lower the number, the less it bounces around. SPY's number is slightly below average, which means it tends to be a little more stable than most ETFs. Not the safest thing ever, but definitely not wild either. Then there's the turnover rate, which is just how often the ETF changes the stocks it holds. SPY's turnover is super low, just 3%. That's a good thing. It means the fund isn't constantly buying and selling stocks, which helps keep costs low and your tax bill lighter. And finally, SPY's tracking error is really small. That's just a fancy way of saying it follows its target, the S&P 500, very closely. No surprises, no weird detours. What you see is what you get. This is a very solid ETF, but is this the one to choose above all? In the end, I'll compare all the ETFs to show how a $7 daily investment in the best one could add an extra $500,000 to your portfolio and pay over $70K in annual dividends. Now let's take a look at the next ETF, Vanguard Dividend Appreciation Index Fund with a ticker symbol VIG. The VIG is designed for investors seeking stability, consistency, and long-term dividend growth. Unlike high-yield ETFs that prioritize immediate income, VIG focuses on companies with a solid track record of increasing their dividends year after year. This disciplined approach to dividend quality has made VIG a cornerstone in many long-term investment portfolios. Looking at performance, VIG returned about 8.67% over the past year. Over 5 years, 68.46%. And in the last decade, a strong 161.46%. It's not the flashiest ETF out there, but it quietly gets the job done, growing your money and keeping your ride fairly smooth along the way. That said, its dividend payout rate is $3.52. While the yield may appear modest compared to more income-heavy ETFs, its strength lies in the consistency and upward trajectory of its payouts. While its fund's expense ratio is notably low at 0.05%, it enhances long-term efficiency and keeps costs minimal for investors. With $108.81 billion in assets under management, VIG is one of the largest and most trusted dividend-focused ETFs on the market. However, its diversified composition spans several key sectors led by technology, financials, healthcare, consumer defensive, and industrials, creating a robust foundation that's resilient across market cycles. VIG's top holdings include some of the most respected and financially stable corporations such as Broadcom, Microsoft, JP Morgan Chase, Apple, and Visa, etc. These companies are known not just for strong earnings, but also for their commitment to returning value to shareholders through regular and growing dividends. Now, in terms of risk, VIG keeps things calm. Its standard deviation is 11.69, which just means it doesn't bounce around as much as most ETFs. And with only about 32% of its money in the top 10 stocks, it's pretty well spread out. That lowers the chance of one company dragging everything down. Now, let's take a look at the next ETF on our list. Vanguard Mid-Cap Value Index Fund ETF with a ticker symbol VOE. This ETF strikes a compelling balance between dividend yield, growth potential, and value exposure. It's ideal for investors who want a middle ground, not too risky, but still with plenty of upside. It bridges the gap between aggressive growth strategies and conservative income plays, offering a pragmatic approach to building long-term wealth. Over the past year, it's up 5.62%. In the last 5 years, it has delivered a return of 67.15%, and over the past 10 years, the ETF has surged 86.18%. That performance alone is solid, but what adds to its appeal is its consistency over time. This ETF invests in mid to large cap US companies that show both strong fundamentals and a proven track record of paying dividends. It's designed to capture the performance of companies that are undervalued relative to their earnings and book value, providing built-in downside protection during volatile periods. Its expense ratio sits at 0.07%, which is extremely low and helps maximize investor returns. It has a trailing 12-month dividend rate of $3.72. It pays quarterly dividends and has over $30.57 billion in assets under management. The ETF tracks the performance of the CRSP US Value Index, emphasizing companies with strong earnings, consistent profitability, and a long-term orientation. The top sectors in this ETF are financials, 17.43%, industrials, 13.41%, utilities, 11.75%, consumer defensive, 9.88%, technology, 9.85%, and real estate, 8.15%. The largest holdings include Arthur J., CRH, PLC, Newmont, and many more. From a risk perspective, the ETF has a standard deviation of 14.43%, which places it slightly above average in terms of volatility, but not excessively so. Its one-year tracking error is 9.37%, and it has a turnover rate of 19%, meaning it doesn't aggressively trade holdings, another indicator of its stable, patient approach. Next up, we have a fund that's a staple for investors chasing higher than average dividend income without entirely giving up on growth. iShares Select Dividend ETF with a ticker symbol DVY. This ETF stands out for its emphasis on consistent income generation, making it particularly appealing to retirees or anyone seeking steady cash flow from their investments. It's the kind of fund you might pick up if you're aiming to create a stream of passive income you can rely on, month after month, year after year. Over the past 1 year, the fund is up 5.11%. It's delivered a 62.67% return over the last 5 years and 80.41% over the past decade. That's not sky high, but that's also not what this ETF is trying to do. It's more about stability and dependability, not chasing big growth spikes. Now, with a trailing 12-month dividend rate of $5.15, this ETF is firmly focused on income. Dividends are paid quarterly, which aligns well with the needs of investors looking to budget or reinvest on a seasonal basis. The expense ratio is 0.38%, a little higher than some of the others we've talked about, but still reasonable given the focus on higher-yielding companies. The ETF manages around $19.95 billion in assets and is specifically designed to capture high dividend-paying U.S. companies. DVY holds about 107 U.S. companies, and it leans hard into sectors that are known for consistent dividends. Financials and utilities make up over half of the portfolio. You'll also find exposure to consumer staples, energy, and communication services. This isn't a tech-heavy ETF. Tech only makes up about 4.5%, and that's on purpose. This fund avoids the more volatile growth stuff and sticks with income producers like Ford, Altria, and Pfizer. On the risk side, DVY has a standard deviation of 15.38, which means it moves around a bit more than others like VIG, but it's not wild. With a turnover rate of 19%, it's not constantly trading in and out of positions. That's good. It means it's a patient investor, just like the people it's built for. So if your goal is reliable income over time, DVY delivers. It's not going to moonshot your portfolio, but that's the point. It keeps things stable and pays you to wait. But if you're looking for a fund that blends income and growth and does it with rock-bottom fees, the final ETF on our list might just be the one to beat. Schwab US Dividend Equity ETF with a ticker symbol SCHD. In the end, I'll compare all the ETFs to show how a $7 daily investment in the best one could add an extra $500,000 to your portfolio and pay over $70K in annual dividends. But first, let's get to know SCHD. Many investors consider this ETF a crown jewel for dividend growth, the one that just deserves a permanent spot in your portfolio. It strikes an impressive balance between income, growth, low fees, and long-term performance. Now, let's be real. The past year hasn't been amazing. SCHD dipped slightly, down about 1.09%. But that's just one chapter. Zoom out a bit and the story changes. Up 52.61% over 5 years and 113.93% over the past decade. That's where SCHD really shows its strength. Long-term, steady performance with the kind of compounding that builds serious wealth over time. Its trailing 12-month dividend rate stands at $1.03. Investors receive payouts quarterly, offering a consistent source of income you can count on. Whether you're reinvesting those dividends or relying on them for spending, that regularity makes a big difference in your financial planning. And just like the rest of the top-tier ETFs we've looked at, it keeps fees super low, just 0.06%. That means more of your returns stay with you. So, how does it work? SCHD only includes companies that meet some pretty strict standards, at least 10 years of consistent dividend payments, strong profitability, healthy balance sheets, and a good track record of rewarding shareholders. That screening helps weed out the flaky stuff and focus on high-quality, dependable companies. SCHD spreads your investment across a bunch of solid sectors, but it doesn't just throw money everywhere. It's got the biggest chunks in energy, consumer staples, and healthcare. We're talking companies that sell essential stuff and stay profitable even when the economy gets rough. You'll also see some exposure to tech, industrials, and consumer goods, but it avoids sectors like utilities and basic materials almost entirely. And that's intentional. It's focused on quality over quantity. Its top 10 holdings make up about 40% of the fund, which means it's somewhat concentrated but not overly risky. And it's packed with names you probably recognize: Texas Instruments, Chevron, PepsiCo, Merck. Big, stable businesses that have a strong history of paying and growing their dividends. In total, SCHD holds 103 different companies, so you're still getting solid diversification, but more importantly, it's diversification with purpose, carefully chosen for dividend strength, not just spread out for the sake of it. From a risk standpoint, it holds its ground well. SCHD has a standard deviation of 14.64 and a turnover rate of just 29%, meaning it doesn't aggressively shuffle its holdings. The 5-year tracking error is 9.78%, modest for a smart beta strategy and a reflection of its disciplined approach. Altogether, SCHD brings together high yield, strong long-term returns, rock-bottom fees, and a proven portfolio strategy. Alright, now that we've walked through all 5 solid ETFs, let's take a step back and look at the big picture. Each of these funds brings something valuable to the table. SPY is the king of total return. It's broad, proven, and powerful for long-term growth, but here's the thing, it just doesn't deliver much income. So if you're someone who wants your investment to eventually pay you real spendable cash, SPY leaves you short. Then we've got VIG. Super solid, super consistent. It focuses on quality companies that grow their dividends every year, but it plays a bit too cautious. The yield is low, the growth is slow, and over time that means less income and a smaller overall return. VOE gives you value exposure. It targets those underpriced, overlooked companies with potential, but the growth is softer, the income is decent, but not standout, and the risk can creep higher than you'd expect. It's not bad, it just doesn't lead in any category. DVY is the go-to for upfront income. It's great if you want steady cash flow, especially in retirement, but the trade-off is clear: less diversification, more sector risk, and not much growth to speak of. You get paid, but your investment doesn't do much growing in the background. Every fund we've looked at had strengths, but also had gaps. They each made you pick between one good thing and giving up another. But not SCHD, and that's why a lot of investors call this one the gold standard for dividend growth. And honestly, it's easy to see why. SCHD gives you SPY's long-term growth but with real dividend income along the way. It delivers VIG's commitment to quality, but with more yield and better upside. It captures VOE's value discipline, but does it with stronger companies and better risk control. And it gives you DVY-level income, but with smarter diversification, less concentration risk, and actual capital appreciation. So instead of settling for one type of strategy, growth or income, stability or performance, you get a fund that blends the best parts of all of them. That's what makes SCHD different. That's why this is the one ETF I'd pick above all the others. If I had to put all my chips on one ETF for the next 30 years, this is it. Now, here's where it gets really exciting. What happens if you actually stick with SCHD over the long haul? Let's say you don't start with a huge lump sum. You just invest $7 a day, the cost of a sandwich or a streaming subscription. And from there, we let three powerful forces go to work. A dividend yield of 3.75%, an average dividend growth rate of 10.77%, and a share price that's historically grown about 7.61% per year. Here's what that looks like over time. In year 1, you'd have invested about $2,555. At year 10, your portfolio would be worth about $45,000, generating around $2,000 a year in dividends. Fast forward to year 20, the portfolio will be valued at $209,000 and dividend income crosses $12,000 per year. Now, fast forward to year 30, and this is where things really take off. Your account balance would hit roughly $953,000, and your yearly dividend income would hit $75,000, or about $6,250 per month. All of that from just $7 a day. You might be thinking, hey, the other ETFs perform pretty well too. And you're right, each one has its strengths, and depending on your priorities, any one of them could play a role in a solid portfolio. But let's step back and compare them side by side, specifically in two key areas: how much your portfolio grows and how much income it actually pays you. And see why I have SCHD as my one best ETF in 2025. Let's start with the big number, total portfolio value after 30 years. If you stick to just $7 a day, I will start from the bottom and work our way up. VOE comes in with a final portfolio value of around $450,000. It's a value-focused ETF, and while it's consistent, it's also more conservative, so the overall growth stays modest. Next up is VIG, finishing with about $503,000. It's steady and reliable, but because it plays things safe and sticks to lower-yielding stocks, the growth doesn't compound as aggressively. DVY edges ahead slightly at $528,000. That extra boost comes from its higher income payouts, but since it doesn't grow as quickly, it levels out right in the middle of the pack. Then there's SPY, finishing at a solid $605,000. Its strength is capital appreciation, so if you're just looking for your investment to grow over time, this is one of the stronger contenders. But leading the group by a mile is SCHD, with a final portfolio value of around $953,000. That's nearly $500,000 more than VOE, the lowest performer in the group. And even compared to the next best, SPY, at $605,000, SCHD still pulls ahead by almost $350,000. Now let's talk about income, because this is where things really start to separate. At the very bottom, we've got SPY, bringing in just about $1,000 a year in dividend income after 30 years. VIG does a bit better, delivering around $4,000 annually. It's focused on quality and dividend growth, but the yield stays low, so income takes time to build and it never really takes off. VOE steps it up with about $22,000 per year. That's a respectable middle ground. Decent yield, moderate growth, not bad at all. Then there's DVY, the income specialist. It's designed for payouts and it delivers around $31,000 a year in dividends. That's a strong result if you're focused purely on cash flow, but sitting far above the rest is SCHD, pulling in an estimated $75,000 a year in dividend income. That's over $44,000 more than DVY, and a massive $74,000 more than SPY. That's the difference between picking a fund that pays you and picking one that could fund your life. SCHD is the gold standard of dividend ETFs. It's reliable, consistent, and filled with top dividend-paying US companies. But here's what most people don't realize. SCHD alone might actually slow you down. Not because it's bad, far from it, but because it's incomplete. While it offers stability and income, it leaves out two major forces that drive long-term wealth: global growth and tech innovation. Without those, your portfolio might be solid, but not strong enough to reach your goals faster. The solution isn't abandoning SCHD, it's adding what it's missing. In this video, I'm going to show you and Josh the core risk involved, how to fix those blind spots, and at the end of this video, you'll see exactly how to combine SCHD with two powerful ETFs that cover what it's missing. I'll walk you through three easy-to-follow strategies. One if you're in your 20s or 30s, one for your 40s, and one if you're 50 or older. So no matter where you are in life, you'll know exactly how to build a $1 million portfolio. But first, why SCHD isn't a complete plan. So here's the thing, SCHD is a great ETF, like really solid. It's packed with big, reliable US companies with strong fundamentals and a solid track record of paying dividends. Investors love it because it's predictable, consistent, and has weathered market storms better than most. That's exactly why so many investors love it. But here's the problem. If your entire retirement plan depends on SCHD alone, you might be setting yourself up for a slower journey than you think. Let me show you what I mean through two different investors, Peter and Josh. Peter is our play it safe guy, conservative, focused, and disciplined. He reminds me a lot of the folks who love SCHD. Then there's Josh, more open to growth, willing to diversify, but still smart about risk. We're going to follow both of them so that you can see how these two mindsets play out over time and why relying on just one strategy could cost you hundreds of thousands of dollars. Let's start with Peter. Back in the late 1990s, while everyone else was jumping into wild tech stocks, Peter stuck to what he knew: reliable dividend-paying US companies, the kind you'd find in SCHD today. So when the dot-com bubble burst in 2000, Peter barely flinched. While portfolios around him were collapsing, his held steady. On the surface, it looked like he'd won. Now meet Josh. Josh also saw the crash, but instead of clinging to just one style of investing, he stayed open. He learned from the recovery. He saw that while Peter's portfolio was steady, it wasn't growing. Josh started shifting some of his money toward innovation, toward companies like Apple, Microsoft, Nvidia, and also began diversifying globally. He didn't abandon safety, but he didn't let it trap him either. And that's where the paths really split, because markets don't stand still. Over the next decade, the tech industry reshaped the global economy. Companies like Apple, Microsoft, Nvidia, and others led a historic wave of innovation and wealth creation. The NASDAQ 100, shown in the chart, surged from its post-crash lows and exploded into a multi-decade bull run. Meanwhile, Peter stayed the course with his dividend strategy. His investments stayed stable, his income stayed steady, but his portfolio didn't keep up. He missed one of the greatest wealth-building windows of his generation, not because he made a mistake, but because he never adjusted. That's the real risk. It's not just about losing money, it's about missing opportunities. Like that, many investors today are making the same mistake with SCHD. It feels safe, it pays, and it looks great on paper. But SCHD by design is focused exclusively on US companies. Not just that, but mostly in defensive sectors like energy, consumer staples, and healthcare. Nearly half of its holdings are concentrated in just 10 names. It's a steady vehicle, but not built for acceleration. Over the past decade, SCHD has delivered a total return of 114%. Not bad at all for a dividend-focused ETF. But when you line it up next to growth-heavy giants like QQQ, the difference is staggering. QQQ, which tracks the NASDAQ 100, home to companies like Apple, Nvidia, and Microsoft, returned over 402% in the same period. That's nearly 4 times more growth. SCHD is excellent at preserving wealth and generating income, but that's not the same thing as building wealth quickly. If you're in your 20s, 30s, or even 40s and aiming to retire faster, reach financial independence, or compound your money aggressively, then SCHD can't be your only strategy. It needs reinforcements. That's exactly what I'll show you next, the 3 critical blind spots baked into SCHD's design and how they might be costing you more than you realize. And at the end of this video, I will show you how to combine SCHD with 2 powerful ETFs that fix the 3 blind spots. I'll walk you through 3 easy-to-follow strategies, one if you're in your 20s or 30s, one for your 40s, and one if you're 50 or older. So no matter where you are in life, you'll know exactly how to build a $1 million portfolio. But first, the 3 critical blind spots of SCHD. The first major blind spot is concentration. On the surface, SCHD seems nicely diversified. It holds around 100 stocks, and that feels broad. But when you zoom in, the balance isn't what it seems. Almost 40% of the entire fund is concentrated in just 2 sectors, energy and consumer defensive. That's a massive weight on a narrow slice of the economy. If those sectors underperform, whether due to shifts in policy, inflation, or changes in consumer habits, your whole portfolio gets dragged down. Even more, nearly half of SCHD's holdings are tied up in just 10 companies, so even though it feels broad, it's actually kind of top-heavy. That's not the kind of protection most investors assume they're getting. The second risk is opportunity cost. Because SCHD is built for safety, it leans hard into companies that are stable and mature. That's great for getting consistent dividends, but here's the problem. It often skips the biggest drivers of long-term market returns. High-growth sectors like technology, biotech, and innovation. Companies like Nvidia, Tesla, or even Apple in its earlier years, those don't really show up in SCHD. It skips most of the action in tech, biotech, AI, all the sectors that have driven massive returns over the past decade. So by focusing on safety, you may be sacrificing the very gains that made early retirement possible. The third one is geographic exposure, or rather the lack of it. SCHD is 100% US-based, no international stocks, no emerging markets. And sure, the US market is strong, but it's not always the MVP. There have been whole decades where countries like China, India, or Brazil crushed US performance. If something drags the US down, like inflation, debt, or economic slowdown, SCHD has no lifeboat. It's all in on one country, which isn't exactly what most people think of when they hear the word diversified. So if your goal is faster wealth building, you need to plug these three gaps and understand, starting with diversification. Now, I know that word gets thrown around a lot, but here's the thing. True diversification isn't just about owning more stocks. It's about owning the right mix of stocks across different industries, different countries, even different economic cycles. Let's look at what history teaches us, especially the times when the US market wasn't the hero everyone assumed it would be. Most investors obsess over the S&P 500, but that index hasn't always been the world's best performer. In fact, there was an entire decade where sticking solely to US stocks turned into a painful waiting game. Let's rewind to the early 2000s, often called the lost decade for American investors. As shown in the chart, from 2000 to 2010, the S&P 500 essentially went nowhere. After the dot-com crash and the 2008 financial crisis, the index was barely above water by the end of the decade. You could have stayed invested in US stocks the whole time and walked away with almost no gains. Inflation continued to rise, but your portfolio didn't, meaning your purchasing power was shrinking even if your balance didn't. Now let's take a look at what was happening globally. This chart, which tracks the MSCI Emerging Markets Index relative to the MSCI World Index, tells a very different story. From the early 2000s to around 2008, emerging markets were outperforming dramatically. China, India, Brazil, and other developing economies surged ahead. Their markets were thriving, and the reason is simple. Economic cycles across the globe don't align perfectly. When the US stumbles, other countries can sprint. Investors who diversified globally during that time avoided a slow decade, and they positioned themselves to grow. While US-focused portfolios barely moved, globally diversified ones captured the momentum in faster-growing markets and came out well ahead. Fast forward to today, and yeah, that same warning still holds. If your entire plan rides on SCHD, then you're basically betting everything on just one player, the US market. And don't get me wrong, it's a strong player, but what happens if the next decade looks like the early 2000s all over again? Maybe inflation sticks around, maybe innovation slows, or maybe the weight of US debt finally starts to drag. But diversification isn't just about protecting the downside, it's also about catching the upside. The next Apple or Nvidia might not come out of Silicon Valley, it might come out of Taiwan, South Korea, or Switzerland, and if you're not globally invested, you're gonna miss it. That's why I love VT, and it fixes that problem. It's one simple ETF, but it opens the door to the entire global stock market, not just Wall Street. VT stands for Vanguard Total World Stock Index Fund, and the name says it all. This single ETF gives you a piece of over 10,000 companies, not just from the US, but from all over the world. Big names, small names, developed economies, fast-growing emerging markets, and that's its strength. By spreading across so many geographies and sectors, it minimizes the risk of overexposure to any one economy or industry. In the past year alone, VT has grown 15.81%. Over 5 years, it's delivered 67.38%, and over the last decade, an impressive 114.66%. But it's not just about the returns. VT is also incredibly cost-efficient, with an expense ratio of just 0.06%. That means you keep more of what you earn, less gets lost to fees. Even with over $63.3 billion in assets under management, it stays remarkably steady. Its tracking error is super low, which basically means VT closely follows its index without going off course. That kind of reliability is a big deal if you're aiming for smooth, long-term growth without the drama. What truly sets VT apart is its holdings. Unlike sector-concentrated ETFs like SCHD, VT's top 10 holdings only make up 19.93% of total assets. These include major global players like Nvidia, Microsoft, Apple, Amazon, Meta, Alphabet, Tesla, Broadcom, and Taiwan Semiconductor. These are popular names, companies leading in their fields. They power much of the digital and industrial infrastructure we rely on today. The broader sector allocation tells an even richer story: 25.59% in tech, 17.31% in financials, 11.37% in industrials, and 8.91% in healthcare. This spread gives you exposure to both high-growth areas and more stable income-generating sectors. It's a thoughtfully balanced approach that allows VT to perform well in various economic climates. For investors seeking dependable, broad-based global exposure without needing to constantly rebalance or research international stocks, VT is a practical and powerful choice. It doesn't try to outperform the world, it simply owns it. And in the long run, that can be enough to win. So now you've got global diversification covered with VT, and you've got a safe income-generating core with SCHD. That's a strong foundation. But if your goal is to hit that $1 million retirement mark faster, really accelerate your growth, there's still one more piece you need. You can't afford to miss out on growth stocks, and that's exactly where QQQ comes in. If there's one ETF built for chasing innovation and long-term growth, it's Invesco's QQQ. It tracks the NASDAQ 100, a lineup of the most disruptive, world-shaping companies out there. From artificial intelligence and semiconductors to electric vehicles, e-commerce, and cloud tech, QQQ gives you a front-row seat to the digital transformation that's already reshaping the global economy. Let's look at the numbers. In just the past 12 months, QQQ has gained 22.47%. Over 5 years, it's up 121.23%. And over the last decade, a massive 414.73% return. Now, to be clear, QQQ isn't designed for stability or high income. It's more volatile than SCHD or VT, and it offers a lower dividend, currently around $2.82 per share. But that's not why you own it. You own QQQ for growth, for the chance to capture the next wave of major tech breakthroughs before they go mainstream. And even with all that upside, QQQ is still cost-effective. Its expense ratio is just 0.2%, which is reasonable considering the caliber of companies it holds. It's also extremely liquid, with over 31 million shares traded daily, so it's easy to move in or out when needed with minimal friction. So where does all that growth come from? When you look into the holdings, it's pretty clear. Over half of QQQ, 51.03% to be exact, is concentrated in just 10 companies. And they're not just any companies. Right at the top, Nvidia, Microsoft, Apple, Amazon, and Meta. These firms are market leaders, category creators, and industry disruptors, setting the pace for global tech advancement. In terms of sectors, QQQ leans heavily toward growth. Technology makes up 53.9% of the fund, with another 15.7% in communication services and 13.34% in consumer cyclical. That means it's less about slow and steady income and more about massive capital appreciation, something SCHD lacks. It shouldn't be the whole vehicle, but even a 30 to 40% allocation for a young investor could dramatically amplify long-term results, especially when paired with steadier ETFs like SCHD or globally balanced ones like VT. Now let's break down 3 ETF-based strategies using SCHD, VT, and QQQ, each tailored to different investor profiles. Depending on where you are in life, whether you're just getting started, in your 40s, or nearing retirement, your investment strategy should evolve. There's no one-size-fits-all. It's all about adjusting your mix as your goals and risk tolerance change. Most people go through 3 main stages. In your 20s and 30s, it's about growth. In your 40s, you want more balance, growth with some stability. And in your 50s and beyond, the focus shifts to preserving your wealth and generating income. So here's what we'll do. I'll walk you through 3 different portfolio strategies using the same 3 ETFs, SCHD, VT, and QQQ, tailored to each stage of life, and retire with $1 million portfolio. You'll meet Josh, the aggressive growth investor in his 20s, then John, who's in his 40s and looking for balance, and finally Jasek, who's focused on income and preservation as retirement gets closer. Let's start with Josh. Josh is in his 20s, maybe early 30s. Like a lot of people his age, he's probably not sitting on a big pile of savings. Between student loans and starting out in his career, big investments aren't realistic right now. That's totally normal. That's why this strategy keeps it simple. $10 a day. It's affordable. Josh also has something most investors wish they had more of: time. That gives him room to take more risk and lean into growth. So his portfolio is built with 30% in SCHD for steady income, 30% in VT for global exposure, and 40% in QQQ to capture innovation and long-term upside. This portfolio strategy offers a dividend yield of 1.84%, a 10-year dividend growth rate of 8.49%, and an expected annual share price growth of 11.82%. Now, let's see what that looks like with a simple daily contribution of $10. The red line tracks Josh's dividend income, starting at 0 and growing to about $800 a year by year 10. By year 20, it reaches $2,600, and by year 30, it's bringing in $6,000 annually. At the same time, the green line shows how his total portfolio value grows. It begins at just $3,650 in year 1, climbs to $68,000 by year 10, hits $298,000 by year 20, and passes the $1 million mark in year 30, finishing at $1,043,000. Next up is John. He's in his 40s, earning more than he did in his 20s, and starting to think more seriously about retirement. He still wants his money to grow, but now there's also a focus on keeping it safe. That's where the balanced wealth compounder strategy comes in. John's portfolio is built with 40% in SCHD for consistent income, 30% in VT for global diversification, and 30% in QQQ to stay connected to growth and innovation. With that setup, the portfolio has a dividend yield of 2.17%, a 10-year dividend growth rate of 8.6%, and an expected share price appreciation of 10.83%. At this stage in life, John likely has a bit more saved, so we assume he's starting with $45,000 and contributing $20 a day, or about $7,300 a year. That might sound like a lot, but for someone in their 40s with a stable income, it's a realistic, meaningful way to build serious momentum. So what does that look like in real terms? The red line tracks John's dividend income, which starts at around $1,000 a year in year 1 and climbs to $4,000 by year 10, then reaches $13,000 by year 20. At the same time, the green line shows his portfolio balance growing from $58,000 in year 1 to $283,000 in year 10, and crossing the $1 million mark by year 20, ending at around $1,040,000. Last up is Jasik. He's in his 50s, maybe even early 60s, and retirement is starting to come into focus. At this stage, the priority shifts. It's less about chasing aggressive growth and more about protecting what you've built and generating steady income. That's where the capital preservation and income plan comes in. Jasik's portfolio leans into stability, with 50% in SCHD for dependable dividends, 30% in VT for global diversification, and a smaller 20% in QQQ to keep some exposure to growth without the full volatility. With this strategy, his portfolio delivers a 2.49% dividend yield, a 10-year dividend growth rate of 8.72%, and expected annual share price appreciation of 9.85%. We assume Jasik has a stronger financial base, so he starts with $270K already invested and continues contributing $25 a day, or about $9,125 per year. At this point in life, that level of contribution is realistic for someone who saved consistently or sold a business, downsized a home, or simply built up their retirement accounts over time. Let's look at the results. The red line tracks Jasik's dividend income. In year 1, it's already around $7,000 annually. By year 5, it grows to $11,000, and by year 10, it hits $20,000, providing meaningful income as he approaches or enters retirement. The green line shows his portfolio balance starting at $312,000, growing to $540,000 by year 5, and breaking the $1 million mark by year 10, finishing at $1,017,000. SCHD gives you a strong foundation, but if you want to reach your retirement of $1 million faster, you need to fill the gaps. Add global growth with VT. Add innovation with QQQ. Together, they fill the gaps and give you a smarter, faster path to $1 million future.
You might spend your whole life working full-time for a $5,000 a month salary, which some people argue is a small reward for decades of effort.
Or you could invest $10 a day and let 2 ETFs do the heavy lifting. One builds income, the other builds wealth. Together, they could retire you with a $2 million portfolio and pay you $17,000 a month, passively, for life. In this video, I'm going to show you and Josh how 2 ETFs can do what most retirement plans never will. I'll break down how these funds were picked and what kind of results they've delivered over time. In the end, I'll show you an ETF that turns a $10 daily investment into a portfolio that pays over $15,000 in monthly dividend income, and another ETF that turns that same $10 a day into a massive $2 million retirement fund. But first, let's take a quick reality check together. Just you and me, talking like friends. Right now, the average full-time worker in the US earns about $62,000 a year. Not bad on paper, right? It's enough to cover bills, maybe save a little, and hopefully enjoy some comforts along the way. But here's where things start to feel a little off. You're trading roughly 40 hours a week, every week, for decades. You show up, work hard, and do everything by the book. And if you're diligent, if you play it safe and contribute steadily to your 401k, guess what you'll likely end up with by retirement? About $244,000. That's the average 401k balance for folks between 55 and 64 years old. After a lifetime of effort, that's the reward. Now, I'm not saying that number's nothing. It's definitely something. But if we're being honest, it's not even close to enough to truly replace a full-time income, let alone fund the kind of freedom most people dream about for their retirement. And this isn't a hypothetical. These are real numbers pulled from solid sources like the US Bureau of Labor Statistics and NerdWallet. The full breakdown's there if you want it, but the bottom line is simple. Most people are working their whole lives for a retirement that still feels tight. So now the question becomes, is there a smarter way to play this game? Because if the traditional path is leading most people to this kind of result, maybe it's time to rethink the strategy. And that's exactly where this 2 ETF approach steps in. My income goal? Simple. Build a steady stream that can beat what the average retirement gives you. Something like 15 grand a month in passive income. That money's coming in whether I'm working or not. And for that, I've got one ETF doing the heavy lifting. Then there's the second goal. Grow a portfolio that could hit 7 figures over time. Not from gambling on risky stocks, but by stacking solid growth year after year. That's where the second ETF comes in. So yeah, 2 goals, 2 ETFs. One plan that could seriously change the way you think about wealth building. And it starts by understanding why keeping it simple is actually the smartest move you can make. The financial world loves complexity. There's always a new chart, a new fund, a new trend. CNBC runs 24/7 for a reason. It's built on the idea that more information equals better decisions. But here's the uncomfortable truth. More complexity usually means worse performance. Study after study shows that most actively managed funds, the ones with the highest fees and the smartest sounding managers, consistently underperform the market. Not by a little. Over time, nearly 80% of them lose to a simple index fund. Why? Because complexity breeds mistakes. It breeds overtrading, emotional decisions, and chasing what's hot instead of what's working. Warren Buffett, arguably the greatest investor of all time, has said repeatedly that most people should avoid trying to beat the market. Instead, they should own it. Buy simple, low-cost, diversified funds and hold them for a long time. John Bogle, the founder of Vanguard, went even further. Don't look for the needle in the haystack, just buy the haystack. That's where the 2 ETFs we're talking about come in. They're not exciting in the way meme stocks are. They don't make headlines like Bitcoin. But they do something far more important. They work. They've consistently grown, paid dividends, and weathered every kind of market condition, while most people were glued to their screens. Simplicity gives you clarity. It lets you avoid decision fatigue. You don't have to wonder what to buy next or when to sell. You just stick to the plan, and the plan is built on decades of evidence, not daily predictions. The real edge in investing isn't being smarter than everyone else, it's being more consistent. Most people fail not because they pick the wrong stock, but because they pick a good one and then sell it too early, or they panic in a crash, or they get distracted by the next big thing. So the question isn't, how do I beat the market? The real question is, how do I stop getting in my own way? And the answer begins with picking the right tools, the right ETFs, and letting them do what they were built to do. Let's move to the stock selection criteria. Now, with thousands of ETFs out there, narrowing it down to just 2 might seem like a wild bet, but when you know what to look for, it becomes less about guessing and more about filtering for performance. So let's break down exactly how I selected the 2 stocks for my strategy. First, I looked for funds that had a strong track record. That doesn't mean they had to beat the market every single year, but they needed to show consistency over time, through bull runs, crashes, and sideways markets. The goal isn't to find a fund that shines in only one condition, but one that survives and grows through all of them. Next, I focused on dividend yield. Why? Because dividends don't lie. They represent actual cash paid to shareholders, and they reward you just for holding the investment. But I didn't just chase high yields. I wanted sustainable dividends, meaning the companies inside the fund have strong enough earnings to keep paying, and ideally, increase those payouts every year. That brings us to dividend growth. It's one thing to get paid today, it's another to see that payment grow year after year. The strength of rising dividends is often underestimated, but it's what turns modest income now into sustainable, reliable cash flow later. Over time, even small increases compound into something significant, and that's how a few extra dollars in the early years can evolve into thousands in monthly income without adding a single extra penny out of pocket. In a couple of minutes, I'll show you an ETF that turns a $10 daily investment into a portfolio that pays over $15,000 in monthly dividend income, and another ETF that turns that same $10 a day into a massive $2 million retirement fund. Back to the succession criteria. I also looked at share price growth, because while income is great, you also want your portfolio itself to grow in value. That's where compounding takes over. The longer you stay invested, the more those gains start working on top of each other. And finally, I dug into the holdings of each fund, the actual companies inside. Are they spread across solid sectors? Are they well managed? Profitable? Do they make stuff people use no matter what the economy's doing? So here's the blend. One ETF is selected on the basis of creating income growth because it boosts the cash flow with rising dividends, and does so with a disciplined value-based strategy. The other is picked because it mimics what most people hope to get from their retirement accounts: long-term, aggressive capital growth driven by global tech leaders. I'll break down both in detail, starting with the one designed to pay you. This is the income engine of the strategy, and its name is SCHD. The Schwab U.S. Dividend Equity ETF, or SCHD, is one of the most respected dividend-focused ETFs in the market. Its reputation is built not on hype, but on its ability to deliver strong, consistent income and stable capital growth through high-quality U.S. companies. It's an ETF designed for investors who want to build wealth without constantly checking charts or reacting to news headlines. Historically, SCHD has shown solid performance across different time periods. In the most recent 12 months, it delivered a return of 1.9%, holding up well through a year marked by volatility and uncertainty. Over the past 5 years, SCHD gained 47.66%, reflecting steady capital appreciation. Over a 10-year span, SCHD has more than doubled in value, gaining 100.25%, underscoring its ability to generate real, lasting returns, all while consistently paying out dividends. The strength of SCHD lies in its holdings, companies that are well-established, profitable, and generous with their dividends. Its portfolio includes names like Coca-Cola, holding 4.32%, Verizon 4.29%, Altria 4.23%, Lockheed Martin, Cisco, ConocoPhillips, Home Depot, and a bunch of household names. Together, the top 10 holdings make up about 41% of the ETF. These are not high-growth disruptors. They're stable, revenue-generating giants. When you break down the sectors, you'll find SCHD is tilted toward consumer defensive 19.58%, energy 18.98%, and healthcare 14.44%. These sectors provide products and services people can't easily cut from their lives, making them more resilient during economic downturns. SCHD also spreads some weight into industrials and tech, around 11% each, which adds a bit of efficiency and innovation to the mix. And to round things out, it has smaller chunks in areas like consumer cyclical, financials, and communication services, just enough to keep things balanced without watering down the strategy. As for the core financial metrics that define SCHD's appeal, it starts with a dividend yield of 3.97%. This is well above the market average and provides a solid baseline of income. But income alone isn't enough. That's where SCHD's 10-year dividend growth rate stands out. Over the past 10 years, SCHD's dividends have grown at an average rate of 11.3% every year, and with a 7.02% average annual share price appreciation, SCHD strikes a rare balance. It grows your capital while growing your income. All of this comes with an ultra-low expense ratio of 0.06%, which keeps more of your gains in your account. This makes SCHD not only reliable, but efficient, a critical factor when investing for the long term. Let's say you start investing just $10 a day into SCHD, and every time this ETF pays you a dividend, you don't spend it, you reinvest it. So after 1 year, your investment would add up to $3,650. This sets the stage for future growth. Stay consistent, and by year 10, you will have built it up to around $65,000. Fast forward to year 20, and your investment will have reached about $320,000, all from simply sticking with that $10 a day habit. Now here's where it gets really exciting. By the time you hit year 30, your portfolio will have crossed into millionaire status, sitting at roughly $1.79 million. These numbers are based on SCHD's historical growth and reinvestment behavior. The most compelling part? The dividend income you'd be receiving by year 30? $199,000 annually, or around $17,000 every single month. The total value of the portfolio stands at $1,683,000. When we break it down, $656,000 comes from capital appreciation, while a substantial $1,027,000 is the result of reinvested dividends. That means over 57% of your wealth in this strategy doesn't come from market movement. It comes from owning an ETF that pays you and then putting those payments back to work. Now let's shift gears to the second half of this powerhouse duo, the ETF that's all about acceleration and long-term growth. If SCHD is the income engine of this portfolio, QQQ is the rocket fuel. The Invesco QQQ ETF with a ticker symbol QQQ is one of the most well-known and heavily traded ETFs in the world, and for good reason. It tracks the NASDAQ 100 index, giving you direct exposure to 100 of the largest non-financial companies listed on the NASDAQ. These are the innovators, the disruptors, and the powerhouses that are shaping the future of the global economy. Over the last decade, QQQ has developed a reputation not just for consistent performance, but for dominant performance. Looking at its recent returns, the numbers speak for themselves. In the past year alone, QQQ is up 15.47%, showing its resilience and ability to bounce back quickly from volatility. Over the past 5 years, it has delivered a stunning 122.05% return. And zooming out to a 10-year view, QQQ has skyrocketed by 381.11%. That kind of compounding is what separates retirement from the simple 401k retirement accounts. So, what's really driving those big returns from QQQ? It all comes down to what's inside. This ETF is built to lean into technology big time. Over half of its entire portfolio, about 52%, is made up of tech companies. That means you're heavily invested in innovation and scalability, businesses that grow rapidly and dominate global markets. Following tech, there's communication services making up 15.74% of the ETF, consumer cyclical 13.39%, and smaller allocations to sectors like healthcare, industrials, utilities, and real estate. But the real star of QQQ is its top holdings, the companies that define the modern world. Right at the top, you've got Microsoft, which makes up about 8.6% of the fund. Then comes Nvidia at 8.3%, Apple at 7.6%, Amazon at 5.5%, and Broadcom at 4.7%. Just those 5 alone, they make up more than a third of the entire ETF. And it doesn't stop there. QQQ also includes giants like Meta, Netflix, Tesla, Costco, and Alphabet, some of the most dominant players across social media, streaming, clean energy, retail, and search. Altogether, the top 10 holdings account for just over 50% of QQQ's total value. A highly concentrated bet on the winners of tomorrow. First off, the dividend yield is on the lower side, sitting at about 0.58%, and that's totally expected. Most of the companies in QQQ are focused on growth. They're reinvesting profits back into their businesses instead of paying them out. But that doesn't mean dividends are off the table. Over the last 10 years, QQQ has still managed to grow its dividend payouts at an average rate of 10.3% a year. So even though the income is small now, it's quietly growing in the background. But the real star here is the share price growth. QQQ's average annual return from price appreciation alone is a whopping 16.78%. If that trend continues, it means your money could more than double every 5 years. That's the kind of compounding that turns a small start into serious wealth. Now, let's quickly touch on fees. QQQ has an expense ratio of 0.2%, a little higher than SCHD, but still very low for what you're getting. You're gaining access to some of the most innovative, high-performing companies on the planet without needing to pick individual stocks or pay for active management. Alright, so what happens if you invest the same way we talked about with SCHD, just $10 a day with dividends reinvested? Here's how it plays out. After year 1, you'll have $3,650. After 10 years, your portfolio will have grown to about $82,000. Keep going, and by year 20, you're looking at $478,000. And by the end of year 30, you're in a whole new league. Your portfolio will have reached around $2.36 million. By year 30, you'd be receiving $1,700 per year in dividends, or about $150 a month. That might not sound life-changing, but remember, QQQ's purpose isn't to generate income now. It's to grow your capital to a level where you have complete flexibility later. So where is all that growth coming from? Out of the $2.24 million total portfolio value, about $2.23 million comes from capital appreciation, pure growth. The remaining $17,000 comes from reinvested dividends. This confirms QQQ's identity. It's a compounding machine, not a cash cow, and it works best for investors who have time, patience, and the discipline to let growth snowball. At the beginning of this video, we set out with 2 clear goals. First, to grow your money into a serious life-changing amount over time. Second, to create an income stream strong enough to rival or even replace a full-time job. Now that we've talked through both ETFs, let's step back and see how they deliver on those goals. SCHD checks the income box with confidence. It's not just about earning dividends, it's about dividends that grow, compound, and eventually take on a life of their own. 30 years from now, SCHD alone could be paying you around $17,000 a month, well above the average American monthly salary of $5,000. QQQ, on the other hand, crushes the growth side of the equation. It doesn't produce much income up front, but that's not what it's built for. It's designed to take your contributions and scale them fast. By year 30, your QQQ portfolio alone would be worth over $2.3 million, absolutely crushing the average 401k savings amount of $244,000. That's the kind of number that gives you real freedom, not just to retire, but to live on your terms whenever you decide it's time. SCHD gives you the cash flow, QQQ gives you the scale, and together they build the perfect income and growth portfolio.
Most people think they're on track for retirement until they take a closer look. The average American has about $87,000 saved, which sounds like a solid chunk of money, but in reality, that might only last a couple of years. Even with Social Security, it's barely enough to live comfortably, let alone retire with confidence. That's why so many people end up delaying retirement, cutting back on their lifestyle, or working far longer than they ever planned. Not because they want to, but because they have to. And honestly, that's not what retirement should feel like. So in this video, I want to show you and Josh a different path, a plan to build a steady, low-stress stream of $2,800 per month in income without having to sell stocks, worry about market crashes, or win the lottery. It's built around just 3 simple index funds, and it works whether you're starting in your 30s, 40s, or even 50s. I'll walk you through exactly how much you'd need to invest, how long it takes, and in the end, I will show you how this 3-index fund portfolio not only pays $2,800 monthly dividends, but also helps you retire as a millionaire. But before we do that, let's set the stage for why. Let's get brutally honest about retirement for a moment. Right now, the average monthly Social Security check is around $1,953. Even if you earned a strong income and waited until age 70 to claim, you might max out around $2,500 a month. But here's the problem. According to the Bureau of Labor Statistics, the average retiree needs between $3,200 and $4,500 a month just to live modestly. That's just covering housing, utilities, food, transportation, healthcare, and maybe a little room for fun. No luxury cruises, no wild spending, just surviving, comfortably. So where does the rest come from? That gap, anywhere from $700 to $2,600 per month, has to come from your savings or investments. But here's where traditional advice fails. Most strategies rely on slowly selling off your investments to cover living costs. But if the market crashes and you're forced to sell at a loss, that plan can collapse overnight. It's not just risky, it's unsustainable. This is why so many people retire later than they wanted, or live with the fear they'll outlive their money. So if selling off your investments isn't the answer, what is? The answer is building a portfolio that pays you without needing to sell a single share. And for the average investor, the most powerful way to do that is through index funds. Index funds are like owning a piece of the entire market. You're not betting on one company. You're owning hundreds, sometimes thousands all at once. automatically, and for almost zero cost. You're not trying to find the next Tesla or time the market. You already own Tesla, Apple, Microsoft, and Amazon without guessing, analyzing, or checking charts. But here's the added benefit. Many index funds also pay dividends. That's real cash in your account, not from selling, not from hope, just from holding shares of businesses that are sharing profits with you quarter after quarter. Now, here's where people go wrong. They chase high-yield ETFs that promise 7%, 8%, even 10%. Sounds great, until a recession hits and those dividends disappear, or the share price tanks. That income turns into anxiety, or they try to pick dividend stocks. Maybe they get lucky. Maybe they buy into the wrong one at the wrong time. It's like building your retirement on guesswork. Some go heavy into REITs or sector-specific ETFs, but those are narrow, volatile, and often come with complex tax consequences that surprise people in retirement. Don't get me wrong, they are very good options, but only if you know what you're doing. And for the average everyday investor who doesn't want to get into the nitty-gritty of things, index funds are the safest funds and are diversified. They're low cost. They survive the storms. Although they're not exciting, but they're consistent. And in retirement, consistency wins. Now let's talk about two tools, foundational investing tools you need to win, that make this strategy completely automatic and almost impossible to mess up. The first tool is tax-advantaged accounts. This is one of the biggest levers you can pull. By investing through accounts like a 401k, 403b, or a Roth IRA, you unlock benefits that regular brokerage accounts can't match. With a 401k, you contribute pre-tax dollars. That lowers your taxable income today, and your investments grow tax-deferred. You only pay taxes when you take the money out later, ideally in retirement when you're in a lower bracket. With a Roth IRA, it's flipped. You pay taxes now, but every bit of growth in income becomes 100% tax-free forever. That means if your Roth IRA grows to $1 million and kicks out 40 grand a year in dividends, you'll owe the IRS zero. You can use both. Maxing these out means more money stays in your pocket and compounds for years, untouched by taxes. The second tool is dollar cost averaging. This means investing the same amount consistently, no matter what the market is doing. Let's say you invest $100 every month. Some months the market's up, you buy fewer shares. Some months it's down, you buy more. Over time, this evens out your cost and removes the emotional stress of trying to time things perfectly. So that's why they're powerful and help to protect you from buying high and selling low, the mistake most investors make when panic sets in. Combine this with tax-advantaged accounts, and you've got a solid setup. The next thing to do is choose your index funds. I will show you and Josh how I choose index funds and the key criteria that separates a reliable dividend payer from a risky disappointment. If you want a consistent rising income for life, it's not enough to just buy stocks that pay dividends. You need to pick the right kind of stocks, or even better, the right kind of index funds packed with them. And no, it's not about chasing the highest yield or picking flashy names off of a Reddit thread. There's a smarter, more sustainable way. The funds I've chosen follow a very specific formula. It starts with dividend yield, but not the kind that makes headlines. I'm not hunting for anything extreme. The sweet spot for index funds is somewhere between 1% and 3%. Stable, backed by strong cash flow, and designed to grow steadily over time. Not too high to be risky, not too low to be useless. But the real growth isn't in the current yield, it's in the growth of that yield over time. When a fund consistently raises its dividends year after year, your income quietly climbs higher, even if you don't invest another dollar. That's why I look at the 10-year dividend growth rate. If a fund has been boosting payouts by 7% to 14% a year for the past decade, that's not an accident. That's a sign of healthy, growing businesses inside that portfolio. And it's not just about income. Growth matters too. When the share price of your fund climbs by 7%, 10%, or even 15% annually, it can grow your portfolio faster in the later years of your retirement. This is how you get compounding working on both fronts, income and capital appreciation, at the same time. Diversification also plays a big role. US markets are strong, sure, but putting all your eggs in one basket is never smart. That's why I include international exposure. It gives me access to some of the biggest dividend-paying international companies, which helps balance and stabilize my returns. And finally, there are the fees. Some funds charge high management fees that eat into your gains, not the ones I choose. I've chosen funds with ultra-low expense ratios, between 0.05 and 0.3%. That means more of your money stays invested and compounding every single day. Now, let's break down the 3 specific index funds in this strategy and show you how each one stacks up. And in the end, I will show you how this 3 index fund portfolio not only pays over $2,800 monthly dividends, but also helps you retire as a millionaire. The first one is the Schwab Target 2045 Index Fund with a ticker symbol SWYHX. Now, don't let the 2045 in the name throw you off. This fund isn't only for the people planning to retire 2 decades from now. It's a dynamic, time-adjusting portfolio built to shift gradually from aggressive growth to capital preservation automatically. Over the past year, it has delivered a 12.64% return. That might seem impressive, and it is, but what's more important is understanding why. Over the last 12 months, the fund has benefited from a rebound in technology and real estate sectors after a rough patch during the 2022-2023 rate hike cycle. The easing of interest rates in 2024 helped growth-oriented holdings bounce back, and that's reflected clearly in this past year's sharp upward trend. Zooming out to the 5-year picture, the fund shows a positive 50.81% return. That span includes major swings. In early 2020, the market plunged with the onset of COVID-19, and you'll see that dip clearly. But like many well-diversified funds, it recovered fast, thanks to its tech-heavy exposure. What followed was a strong 2021, driven by stimulus-fueled gains, followed by a choppy 2022 when inflation and aggressive Fed rate hikes rocked equity markets. Through it all, this fund maintained a balance by holding both stocks and bonds. Over the 10-year horizon, the performance is even more telling. Roughly 93% growth, even with all the global uncertainty packed into that decade. This includes political tensions, the COVID shock, inflation spikes, and economic slowdowns. Yet the long-term trajectory has remained firmly upward, proving how resilient a diversified, time-based index strategy can be when you zoom out and trust the process. The holdings also tell a story. The fund currently holds just 9 assets, with an incredibly concentrated 99.28% of value in the top 10, primarily Schwab's ETFs, including large-cap U.S. stocks, international equities, aggregate bonds, and REITs. It's a ready-made portfolio in a box, covering all the bases without getting overly complex. Sector exposure includes 24.65% in technology, 16.24% in financials, 10.91% in industrials, and solid representation in real estate, healthcare, and communication. These allocations shift slightly over time, but the goal remains the same: strong growth early, with increasing emphasis on stability as the target year nears. On the other hand, its 1.9% forward dividend yield, paired with a low 0.08% expense ratio, makes it appealing for long-term wealth building. And with a moderate 14% turnover ratio, it avoids overtrading, keeping costs low and tax efficiency high. The bottom line is, SWYHX is like a set-it-and-forget-it ship that adjusts its sails automatically. It's built for the long haul and designed to weather whatever the market throws your way without needing you to babysit it. Now let's take a look at a completely different kind of fund. One that leans heavily into growth, innovation, and the tech giants shaping the future. The Fidelity Nasdaq Composite Index Fund with a ticker symbol FNCMX. This index fund is a direct pipeline to the most powerful growth engine in the modern economy: technology. This fund tracks the Nasdaq Composite Index, which means you're essentially holding the pulse of the innovation sector in your portfolio. It's a pure growth play, with an emphasis on agility, disruption, and long-term vision. Over the past year, it went up 21% thanks to a recovery in major tech stocks following a correction early in the year. The market saw a sharp drop in Q1 2025 amid inflation concerns and tightening regulations on AI firms, but that sentiment flipped mid-year as earnings from Nvidia, Microsoft, and other tech giants crushed expectations, pushing valuations higher again. Zooming out to the past 5 years, FNCMX gained a remarkable 94.61%. That period included multiple volatile phases: the 2022 inflation-driven rate hikes, the 2023 market contraction, and then the rally from late 2023 onward as the Federal Reserve paused interest rate increases and confidence returned to growth sectors. Now, looking at a 10-year chart, the picture is even more dramatic. FNCMX is up a staggering 341.42% over the past decade. Now, let's take a peek inside the fund. It holds over 2,700 stocks, but here's the thing: the top 10 make up 57.71% of the portfolio, a tight concentration that gives it a strong growth tilt. So while it's technically very diversified, a lot of the firepower comes from giants like Nvidia, Microsoft, Apple, Amazon, Meta, Google, Tesla, and Netflix. In terms of sectors, FNCMX is heavily tilted toward tech, over 50% in fact. Then there's communication, consumer discretionary, and smaller slices of healthcare and financials. This tilt gives it its power during growth cycles, but yes, it also means it can be more volatile. Now, if you're wondering about fees, the expense ratio is 0.29%, which is totally fair given the exposure you're getting, and the dividend yield is around 0.54%, so this one isn't focused on income. It's about long-term capital growth. One nice bonus: the turnover rate is just 2%, meaning it doesn't do much trading. That's a good thing when it comes to taxes and efficiency. For our portfolio, this will be the growth driver. Now let's round this out with the third fund in the trio, one that brings in international balance, higher dividend income, and some extra stability. The Vanguard European Stock Index Fund Admiral Shares, with a ticker symbol VEUSX. This index fund brings geographical diversification to the portfolio by offering direct exposure to a broad basket of European companies. It offers a forward yield of 2.89%, significantly higher than its US-based counterparts. With an expense ratio of just 0.08%, it remains cost-efficient. Over the past year, VEUSX returned 13%, rebounding from a temporary decline in late 2024. That dip coincided with concerns around slow GDP growth in Germany and inflationary pressures tied to energy prices in the EU. However, by early 2025, those fears began to subside. A more dovish stance from the European Central Bank, combined with improving industrial production and strong earnings from multinational firms like SAP and Nestle, helped push the fund into positive territory. The 5-year return stands at a positive 44.27%, reflecting a moderately paced recovery following several years of economic and political turbulence. Looking at the 10-year horizon, the index fund posted a return of positive 52.42%. Though not as explosive as U.S. growth funds, this performance underscores the long-term potential of a stable, dividend-rich, blue-chip European market. On the other hand, its holdings also tell a story. The steady nature of the fund's core sectors, financials with 23.16%, industrials 20.36%, and healthcare 12.57%, has provided consistent income and some protection against drawdowns. The technology sector accounts for only 7.66%, meaning VEUSX is less sensitive to tech cycles and more aligned with cyclical economic trends in Europe. The top 10 holdings, which make up just 16.33% of the fund, reflect a wide diversification strategy. Major names include SAP SE, ASML Holding NV, Nestle SA, Shell, HSBC, and Siemens, companies with deep international footprints and strong dividend histories. This makes VEUSX particularly attractive for balanced growth with income, while diversifying away from US-centric market risks. While VEUSX may not offer the same rapid capital appreciation as a high-growth fund like FNCMX, it plays a crucial role in a well-rounded retirement strategy, providing resilience, income, and long-term capital preservation through diversified European exposure. In a couple of minutes, I will show you how these three index funds not only pay $2,800 monthly dividends, but also help you retire as a millionaire. But first, let's take a step back and talk about how all three of these funds come together. Because here's the thing, the perfect portfolio doesn't look the same for everyone. It depends on where you are in life, how far you are from retirement, and what kind of growth or income you actually need. So to make this simple, I've put together 3 portfolio paths, each tailored for a different stage of life. We'll start with the first one, something I like to call the growth engine. This one's built for investors in their 30s, people who've got time on their side. Maybe you're just getting serious about retirement, or maybe you've been investing for a few years already. Either way, the goal here is simple: maximize growth while you still have decades to let it compound. So here's how the growth engine is set up. Half the portfolio, 50%, goes into FNCMX. That's your growth driver. Even though the dividend yield is small at 0.54%, it's making up for it with major share price appreciation, around 15.27% annually, plus a solid 8.58% dividend growth rate. Then to balance it out just a bit, 30% goes into SWYHX. This fund brings in a more stable 1.9% yield, grows its dividend at 13.49% per year, and still offers healthy share price growth at 7.44%. It adds that automatic rebalancing, and built-in diversification helps smooth out the bumps without killing your returns. The last 20% goes to VEUSX, the Vanguard European Stock Index Fund. This one adds international exposure with a solid 2.89% dividend yield, a 13.18% dividend growth rate, and a more modest 3.87% annual appreciation. It's a nice counterbalance to the tech-heavy FNCMX. Put it all together, and the full portfolio, the growth engine, delivers a 1.42% dividend yield, a 10.97% dividend growth rate, and a 10.64% annual appreciation. It's the most aggressive of the three strategies because it leans hard into long-term growth. And for someone in their 30s, that's exactly what you want. You've got time to ride the ups and downs, reinvest your dividends, and let compounding do the heavy lifting behind the scenes. I will show you the projections in a couple of minutes, but first let's go through all three portfolios. The second strategy is called the Balance Builder, and it's made for people in their 40s with about 20 years to go before retirement. At this stage, you're still aiming for growth, but now you're starting to think more about protecting what you've already built. So the goal here is to strike a clean balance between compounding and consistency. The portfolio is split 40% into SWYHX, 40% into FNCMX, and 20% into VEUSX. Altogether, this mix gives you a 1.55% dividend yield, an 11.46% dividend growth rate, and about 9.86% in annual appreciation. It's a strong middle ground, enough growth to keep your money working, but with more income and stability baked in compared to a more aggressive setup. And when you give this strategy 20 years to run, it has plenty of time to build serious momentum. You're growing your nest egg, boosting your dividend stream, and staying protected from major swings, all at the same time. And finally, we've got the third strategy. This one's called the Income Protector, and it's built for investors in their 50s who are within about 10 years of retirement. At this point, the focus shifts. You're not chasing big growth anymore. You're prioritizing stability, income, and preserving what you've built. This is where things start to get real. So here's how the portfolio is balanced. 40% goes into VEUSX, with the remaining 60% split evenly between SWYHX and FNCMX at 30% each. When you run the numbers, this strategy delivers a 1.89% dividend yield, a strong 11.89% dividend growth rate, and about 8.36% annual appreciation overall. What makes this portfolio different is how it's designed to handle risk. With retirement getting close, a big market drop at the wrong time could do serious damage, so this strategy leans more into dividend income and growth you can count on, helping reduce the need to sell shares in a downturn and keeping your lifestyle stable. And now the question becomes, how do these strategies play out over time? How much do you need to invest in each portfolio to retire a millionaire and earn over $28,000 in monthly dividend income? That's exactly what I'll show you next. You've seen the structure, the reasoning, and the math behind each portfolio, but it's here where we fast forward through time that things click. This is where strategies transform into outcomes, where numbers become freedom. Take the growth engine as an example. If you're in your 30s, you would have to invest about $27 a day, which comes out to roughly $800 a month to make this plan work. Here's how the projections look. In the very first year, the portfolio doesn't look like much. Dividend income is basically zero, and your balance sits at about $9,855. But give it 10 years, and the picture starts to change. Annual dividend income grows to around $2,000, while the balance climbs to about $174,000. By year 20, the dividend income rises to nearly $10,000 a year, and the balance hits around $720,000. And by year 30, the exponential curve takes over. Dividends grow to about $34,000 annually, or roughly $2,800 per month, and the portfolio balance pushes past $2.4 million. Now let's shift to the Balance Builder, which is designed for your 40s. To make this strategy work, you would have to start with about $100,000 already invested and then add roughly $12,775 per year in contributions. In the very first year, dividend income starts at about $1,554, while the portfolio ends the year with a balance of roughly $124,187. By the 10th year, the compounding effect becomes noticeable, with annual dividend income growing to about $8,000 and the year-end balance reaching around $517,000. Another decade later, by year 20, dividend income gets up to $34,000 annually, while the balance rises to about $1.8 million. Finally, we have the Income Protector, built for investors in their 50s who are within 10 years of retirement. To follow this strategy, you would have to start with about $450,000 already invested, and then add around $14,600 per year in contributions. In the very first year, that setup generates about $8,496 in dividend income, while the portfolio ends the year at roughly $510,721. By year 5, the dividend income would climb to about $16,000 a year, and the balance would rise to around $828,000.
By the 10th year, the effect of compounding is much clearer, with dividend income climbing to nearly $34,000 annually and the portfolio balance expanding to around $1.47 million. So what do these projections really show? Time is your biggest advantage. The longer you invest, the less you need to contribute, and the stronger compounding works for you. But it's also never too late. Even in just a decade, the right strategy can build meaningful income. Most people think compounding is one thing. Reinvest your dividends, let it grow, done. But that's just one piece of the puzzle. There are actually 4, and the other 3 can completely change your results. Using none gets you to $400,000, but using all 4 can take you past $3.5 million. So here's what we're going to do in this video. I'm going to walk you and Josh through each of the 4 compounding methods one by one. We'll look at real investments, track how $100,000 grows over 10, 20, and 30 years with each compounding strategy. Compare what happens when you use just one, and in the end, I will show you how stacking all 4 can turn a $100K investment into a $3.5 million portfolio that pays over $130K in annual dividends. Ask most investors how they're compounding their money, and they'll likely say, "I reinvest my dividends." That's the standard. It's familiar, it feels productive, and to be fair, it does work. Reinvesting dividends is a smart strategy that leads to real results over time. But it's only one form of compounding. In total, there are 4, and relying on just one limits both your income and your long-term portfolio value. Let's start with the one that most people already use, dividend reinvestment. Dividend reinvestment is one of the most widely used and often misunderstood strategies in investing. At its core, it's simple. Instead of withdrawing the cash from dividends paid by your stocks or ETFs, you use that money to purchase more shares automatically. Those new shares then generate their dividends, which repurchase more shares. This turns income into more ownership, and more ownership into even more income. That cycle over time becomes one of the most powerful wealth-building tools available. To understand how impactful this strategy can be, let's walk through a real 30-year scenario with 2 popular dividend payers, SCHD and AbbVie. SCHD, the Schwab U.S. Dividend Equity ETF, offers a diversified basket of high-quality dividend-paying U.S. companies. It pays out about 3.77% in dividends each year, and has been steadily growing those payouts by 10.77% annually, with its share price also climbing a healthy 7.64% per year. AbbVie, a pharmaceutical giant, has built a reputation for aggressive dividend growth. Right now, it pays around 3.47%, a 12.86% dividend growth CAGR, and a strong 10.49% annual share price appreciation. It's a favorite among income-focused investors. Now, let's walk through what happens with these 2 if you invest $50,000 in each for 30 years. I'll compare both stocks side by side with and without reinvestment. Let's start without dividend reinvestment. The investor simply collects dividends as cash and benefits only from price appreciation. After year 1, the SCHD investment grows from $50,000 to $54,000, while AbbVie reaches $55,000, totaling $109,000. At year 10, SCHD is worth $104,000, and AbbVie climbs to $136,000, totaling $240,000. At the 20-year mark, SCHD hits $218,000 while AbbVie reaches $368,000, making a total value of $586,000. And by year 30, SCHD is worth $455,000 while AbbVie finishes at $997,000. Together, that's a portfolio value of $1,452,000. In terms of dividend income without reinvestment, SCHD pays $39,000 per year, or around $3,000 monthly. AbbVie pays $62,000 per year, or $5,000 per month. That's a combined yearly income of $101,000. Now, compare that to what happens when dividends are reinvested from day 1 using DRIP. After the first year, SCHD grows to $56,000 and AbbVie to $57,000, totaling $113,000. At year 10, SCHD reaches $155,000, while AbbVie is at $191,000, totaling $346,000. After 20 years, SCHD jumps to $553,000, and AbbVie hits $799,000, totaling $1,352,000. By year 30, SCHD has grown to $2,376,000, and AbbVie to $3,732,000. Combined, the portfolio value becomes $6,108,000, more than 4 times the value of the non-reinvestment strategy. And the income picture looks completely different too. With DRIP, SCHD generates $187,000 annually in year 30, or about $16,000 per month. AbbVie contributes $218,000 per year, or $18,000 per month. That's a total annual income of $405,000 by year 30, all from the reinvested power of earlier dividends. This massive difference in both portfolio value and income is driven by one change: letting your dividends buy more shares instead of sitting in cash. The more shares you hold, the more dividends you earn. The more dividends you earn, the more shares you accumulate. Over the decades, this cycle multiplies. That's why reinvestment is considered one of the core pillars of long-term dividend investing, but it's only one of 4 major ways your money can compound. This strategy depends on your investments paying dividends, so what happens when they don't? That's what I'll show you next, the second compounding engine, time in the market. Time in the market is the most underestimated strategy in wealth building. It's simple, it's solid, and it works. You don't need to react to the news or jump between the latest trends. The only rule is, stay invested. That alone can be one of the most powerful compounding engines available. It might sound too simple to be effective, but that's exactly why it works. Every year you stay in, the compounding curve starts to bend steeper. And every year you're not in, that's a return you can never get back. Let me show you what this looks like in a real-life example. Josh takes $100,000 and splits it between 2 different investments, $70,000 into VOO and $30,000 into Microsoft. VOO is basically a giant basket of the 500 biggest companies in the US. It's boring, steady, and strong. It gives you exposure to the entire economy with a little dividend on top, about 1.19%, and a history of growing that dividend over time. It also averages about 11.7% a year in price growth. Then you've got Microsoft. This one's a bit of a rocket. It doesn't pay much in dividends, less than 1%, but its price growth is on another level, averaging over 27% a year. If you've ever heard someone say, just hold on to great companies, this is what they mean. So what happens if you just leave those investments alone for 30 years? In year 1, VOO grows to about $79,000. Microsoft reaches $38,000. Together they're at $117,000. At year 10, VOO hits $230,000, and Microsoft leaps to $338,000, making a total value of $568,000. At year 20, VOO rises to $730,000, and Microsoft surges to $3,735,000, totaling $4,465,000. By year 30, VOO is worth $2,267,000, and Microsoft hits an incredible $41,083,000. Together, the portfolio ends at $43,350,000 from a single $100,000 investment. Of course, Microsoft's performance is extraordinary. Most companies won't repeat those results. That's why VOO plays such an important role. It brings balance and a foundation that tracks the broader economy. It protects you if your high-growth pick doesn't live up to the hype. Take a second look at the graph. At first, the lines move up slowly. Year after year, it feels like nothing dramatic is happening. But then, around the halfway mark, you start to see the curve bend. That's the tipping point. That's when time starts doing the heavy lifting. Not because anything changed, but because you stayed in. And from there, the growth keeps accelerating. That last stretch on the right is where the curve goes vertical. And here's the thing, you can't fast forward to this part. You have to earn it by staying invested through the flat, slow, boring early years. That's why time in the market works. It rewards you not for being clever, but for being consistent. And that's also why jumping in and out of the market, chasing headlines or trying to time the perfect moment, it robs you of this curve. It cuts off the part that matters most. So if you've ever felt like your investments aren't moving fast enough, just remember this shape. It's not supposed to be exciting in the beginning. But what this shape lacks is dividends, because it grows investment. In the end, I will show you how stacking all 4 can turn a $100K investment into a $3.5 million portfolio that pays over $130K in annual dividends. And while this strategy doesn't require much activity, you can take it even further by combining it with consistent contributions, adding to your investments regularly to build wealth even faster. The compounding contributions. Consistent contributions may be the most underappreciated compounding strategy of all. Unlike reinvested dividends or price growth, this one doesn't depend on what the market gives you. It's completely driven by your actions, by the money you add regularly and the discipline you stick to over time, and the results can be just as dramatic. Most importantly, compounding contributions build momentum. The earlier you start, the harder your money works. The longer you continue, the more unstoppable the results become. And the dividends you're earning, they become a second source of compounding power, especially if you decide to reinvest them too. This strategy is flexible. It scales with your income, works with any budget, and can be automated so you never have to think twice. Let's see how this plays out in real life using two reliable income-focused investments, VOE and PepsiCo. VOE, the Vanguard Mid-Cap Value ETF, focuses on U.S. mid-sized companies with strong fundamentals and dependable dividends. It offers a 2.2% yield, a dividend growth rate of 9.51%, and share price appreciation of 6.2% annually. Perfect for compounding slowly but steadily. Then there's PepsiCo, a global brand, super consistent and a long-time dividend grower. Its yield is around 3.98%. Its 10-year dividend growth is 7.48%, and it's grown its stock by 3.53% annually. It may not skyrocket, but it shows up every year. Here's how the strategy plays out. Josh begins with $100,000, $60,000 in VOE, and $40,000 in Pepsi. Every month, $1,000 is added in total, $600 into VOE and $400 into Pepsi. After year one, VOE grows to $66,000 and Pepsi to $43,000, totaling $109,000. By year 10, VOE reaches $149,000 and Pepsi hits $95,000, totaling $244,000. At year 20, VOE rises to $388,000 and Pepsi to $265,000, making a total value of $653,000. And by year 30, VOE reaches $1,121,000, while Pepsi climbs to $979,000. That's a final portfolio value of $2,100,000 from $460,000 invested over time. But compounding contributions still depend on the growth and reliability of the assets you invest in. What if you could tilt the odds in your favor even more by investing in companies that increase your income every single year? That's what I'm showing you next, dividend growth compounding. Dividend growth compounding is where income meets acceleration. Instead of chasing the highest yield, this strategy focuses on companies that raise their dividends consistently year after year. That rising payout turns into a compounding force of its own, giving you more income from the same number of shares without lifting a finger. This strategy isn't focused on yield alone. It often leads you to stronger companies, businesses with the earning strength, discipline, and balance sheets to raise dividends year after year. That also means less risk and more resilience when markets get rocky. Dividend growth compounding doesn't provide immediate gratification, but it builds on the previous three compounding factors. In retirement, it can deliver a better income. During your working years, it can be reinvested to accelerate growth even more. Let's break it down with two familiar names, Lowe's and Kroger. Lowe's has long been a top-tier dividend grower. The dividend isn't huge up front, just around 2.11%. But dig deeper, and you'll find a 10-year dividend growth CAGR of 16.97% and a 12.61% annual share price appreciation. It's a classic case of quality compounding over time. Kroger offers a slightly lower yield at 2.02%, but it shines with a 13.52% dividend growth rate and 5.93% annual appreciation. It may not dominate headlines, but it's built steady wealth for patient investors. Now, let's say Josh invests $100,000 into this dividend growth strategy, $60,000 in Lowe's, $40,000 in Kroger. After year one, Lowe's grows to $69,000 and Kroger to $43,000, totaling $112,000. By year 10, Lowe's hits $247,000, while Kroger reaches $93,000, totaling $340,000. At 20 years, Lowe's jumps to $1,142,000 and Kroger to $286,000, making a total value of $1,428,000. And by year 30, Lowe's will be valued at $6,315,000, while Kroger will be valued at $1,534,000. That's a combined portfolio value of $7,849,000 after 3 decades. Now, let's see its dividend income. At year 30, Lowe's delivers $383,000 annually, which works out to $32,000 per month. Kroger pays $211,000 a year, or about $18,000 monthly. That brings the total annual income to $594,000, all from just letting these businesses grow their payouts on schedule. This strategy works because dividend growth is a built-in income escalator. You don't need to buy more shares. And here's the best part. This strategy fits perfectly alongside all the others we've explored. You don't have to pick just one. You can combine them to create a balanced multi-engine approach to wealth. Let's look at what happens when all four compounding engines work together in one portfolio. Using one compounding strategy can take you far, but using all four at once, dividend reinvestment, time in the market, consistent contributions, and dividend growth is where true financial momentum begins. This isn't just diversification, it's an optimization. Each piece multiplies the effects of the others, creating a compounding machine that accelerates on every level. Let's see what that looks like with a real-world portfolio. SCHD for dividend reinvestment, VOO for long-term growth, PepsiCo for consistent contributions, and Lowe's for aggressive dividend growth. We'll split $100,000 evenly, $25,000 in each, and add just $100 per month total. Not much, but that small contribution helps show how powerful the combo really is over time. This mix gives you a 2.76% yield, a dividend growth rate of 10.36%, and long-term capital appreciation averaging 8.87%. Based on these metrics, after 1 year, the total portfolio grows to $113,000. At 10 years, it hits $327,000. By year 20, it climbs to $1,063,000. And by year 30, it reaches a solid $3,579,000, more than 32 times the original investment. But it's not just about growth. This portfolio also builds a reliable and rising income stream, generating yearly dividends by year 30, starting at $3,000 in year 1. By year 10, dividend income triples to $9,000. Year 20 brings in $34,000 a year. By the end of the 30-year period, annual dividend income reaches $134,000. That's over $11,000 a month.
Most people spend $500 without thinking. A phone upgrade, a weekend trip, a few nights out. It's gone before they even realize it. But what if that same $500, used once, intentionally, could build something that pays you $5,000 every month for life? This video is a beginner's guide to a real strategy called smart dividend investing. I'll show you and Josh how you can start a simple portfolio with just $500. I'll walk you through how to choose the right stocks. And by the end, I'll show you how adding just a few dollars extra a day can grow into a $300,000 portfolio, one that pays over $5,000 a month in dividend income. In 2025, the average monthly salary in the US is $5,174, or about $62,000 per year. But that's the gross number. After taxes, most people are taking home far less, often closer to $45,000 to $50,000. And that's before essentials like rent, groceries, insurance, and debt payments. Here's where it gets real. While salaries have gone up over the past decade, so has everything else. Food prices are up nearly 3%. Rent continues to rise in most cities. Utilities, gas, and insurance are all more expensive. Inflation in 2025 is at 2.4% to 2.7%, which might sound manageable, but when your costs are rising and your savings aren't keeping up, it adds up fast. Even if your salary has increased on paper, your buying power may not have. That's the danger of inflation. It erodes your income and savings every single year. And if you're just keeping money in a bank account, you're losing ground. Most savings accounts offer interest far below the rate of inflation. That means your money is shrinking, even if the number stays the same. That's why investing becomes essential. If your money isn't growing faster than inflation, you're falling behind. But with dividend investing, even starting small puts you ahead. And for this video, I'm aiming to reach a portfolio valuation that will pay roughly what the average American gets paid a month. That is, over $5,000 per month in dividend income. Most people think investing is about chasing the next big thing. But the truth is, real wealth is built slowly, and dividend investing is one of the simplest, most reliable ways to do it. When you invest in dividend-paying companies, you're not just hoping the stock goes up, you're getting paid just for owning the stock. That payment is called a dividend. And when you choose the right companies, those payments grow year after year. Dividends are proof that the business is making money, and they're willing to share those profits with you, the investor. And you don't need to pick risky or trendy stocks. Many of the best dividend-paying companies are boring, stable businesses that have been profitable for decades. That's what makes them ideal for beginners. What makes dividend investing powerful isn't just the income, it's what happens when you reinvest those dividends. Instead of taking the cash out, you use it to buy more shares. More shares means more dividends. And over time, your portfolio grows without needing you to add new money. You're earning income while you sleep, whether the market is up or down. That's what separates investors from traders. Traders try to time things. Dividend investors build things. And this strategy rewards the one thing anyone can control: discipline. All you need is a solid strategy and the willingness to stick with it. With time, dividend investing turns a small start into steady, growing income. When you start building a dividend portfolio, you have a few solid paths to choose from, and understanding your options will help you feel more confident in what you're buying. Let's start with dividend ETFs, or exchange-traded funds. These are collections of dividend-paying companies grouped into a single investment. When you buy a dividend ETF, you're essentially owning small pieces of many businesses at once. You don't have to select each stock individually. The ETF takes care of that by following a specific set of rules. This makes ETFs ideal for beginners because they provide instant diversification, reduce risk, and require minimal maintenance. Then there are individual stocks. These give you direct ownership in a single company. This approach lets you be more selective and strategic. If a company has strong dividend growth, stable cash flow, and a good track record, it may be worth owning directly. Individual stocks allow you to customize your portfolio and boost returns, but they require more attention and research compared to ETFs. You also have index funds. These are similar to ETFs but are built to mirror the performance of a broader market segment, like a country or region. Index funds are known for their stability, low fees, and long-term reliability. They're not actively managed, which keeps costs down and results consistent. For investors who want to play it safe and grow slowly but steadily, index funds are a strong option. Here's what's important. You don't have to pick one path. Many smart investors combine ETFs, individual stocks, and index funds into a single portfolio. ETFs add balance and simplicity. Stocks add control and potential upside. Index funds bring global exposure and low-risk growth. Together, they create a portfolio that works in multiple market conditions. This combined strategy forms the backbone of the portfolio that we'll go through next. It's built to be beginner-friendly, diversified, and to grow your income and wealth consistently over time. And at the end, I'll show you what happens when you invest $500 in a carefully crafted portfolio and how an extra $2 a week into this portfolio can grow into a $300,000 portfolio that pays over $5,000 a month in dividend income. But first, let's see the stock selection criteria. Choosing the right dividend investments isn't about luck, it's about having a system. When you're building a long-term income portfolio, you need to filter out the noise and focus on key indicators that lead to consistent returns. For me, first and foremost, I look at dividend yield. This is the percentage of income you earn from a stock relative to its price. A solid dividend yield gives you immediate passive income. However, a yield that is too high can be a red flag, indicating a payout that may be unsustainable or a business in trouble. I aim for a balanced yield that provides good income now and still leaves room for the company to grow. Next is dividend growth, how much the company increases its dividend each year. I focus on the 10-year compound annual growth rate, or CAGR. A high dividend growth rate over a full decade shows long-term commitment and financial strength. These are companies that reward investors regularly and build stronger future payouts. I also look for a good share price appreciation. This portfolio isn't just about collecting dividends. You want your investments to grow in value too. A company that steadily increases in price while paying dividends delivers a double benefit: income and long-term capital gains. Business durability is another key filter. I avoid hype, trends, or speculation. Instead, I look for companies that operate in industries with consistent demand, businesses people rely on year after year through all kinds of economic conditions. This includes companies in consumer goods, financial services, real estate, industrials, and global index strategies. I also prioritize resilience during downturns. Did the company continue to pay or even raise its dividend during market drops or recessions?
That's a sign of smart management, strong financials, and a business model that can handle pressure. Lastly, I look at overall portfolio synergy. Each pick doesn't just stand alone, it complements the others. Some provide stability, some offer growth, and some maximize income. When combined, they form a portfolio with strong average yield, growth, and appreciation. This process helps remove emotion and focus purely on performance, reliability, and long-term potential. Now I'll show you the exact picks that meet all these standards and break down what makes each one worth owning. It starts with the Schwab US Dividend Equity ETF with a ticker symbol SCHD. This ETF is a go-to for investors as a core ETF for a portfolio. It is packed with high-quality US companies that consistently pay and grow their dividends. With a yield of 3.75%, a 10-year dividend growth rate of 10.77%, and an annual price appreciation of 7.69%, SCHD hits the balance between income and stability. For global diversification, the portfolio includes Vanguard's European Stock Index Fund with a ticker symbol VEUSX. This fund tracks large-cap companies across Europe, offering steady income and reduced volatility. It has a dividend yield of 2.93%, with a 13.18% dividend growth rate and 3.47% annual share price appreciation. It's the quiet backbone that helps anchor the portfolio. Next is CubeSmart, with a ticker symbol CUBE, a real estate investment trust focused on self-storage. This business thrives in all kinds of economic conditions, making it an ideal choice for defensive income. Cube pays a 4.91% dividend, has grown that dividend by 13% annually over the last decade, and has increased its share price by 5.43% a year. It offers both consistency and dependable cash flow. Then we have Tractor Supply Company, with a ticker symbol TSCO. Serving rural communities across the country, TSCO has carved out a dominant position in retail. More than just stable, it's been a dividend growth powerhouse. The current dividend yield is 1.62%, but the 10-year growth rate is a staggering 20.8%, alongside annual share price growth of 11.87%. This is a long-term wealth builder. Lastly, we have the Federal Agricultural Mortgage Corporation, with a ticker symbol AGM. This company supports America's agricultural economy and flies under most radars, but its numbers are outstanding. A 3.38% dividend yield, a 25.47% 10-year dividend growth rate, and a 17.03% annual share price appreciation. It's a high-performance dividend machine wrapped in a modest-looking stock. The next step is to calculate your portfolio metrics, and it is fairly simple. To calculate the average dividend yield of the portfolio, you first take the dividend yield of each stock in the portfolio. In this case, we have 5 investments: SCHD, Cube, TSCO, VEUSX, and AGM. Their current dividend yields are 3.75%, 4.91%, 1.62%, 2.93%, and 3.38% respectively. Next, you add all of those yields together. 3.75 plus 4.91 plus 1.62 plus 2.93 plus 3.38 equals 16.59%. Then, since there are 5 stocks, you divide the total by 5. 16.59 divided by 5 equals 3.32%. That 3.32% is the average dividend yield across the portfolio, meaning on average, your investments are paying you that percentage of passive income each year based on their current price. You can use this exact same method to calculate the average dividend growth rate and average annual share price appreciation too. For this portfolio, the average 10-year dividend growth rate is 16.64%, and the average share price appreciation is 9.1%. Now let's break down exactly what happens when you invest only $500 into this dividend portfolio, a one-time investment. After year 1, your investment will be valued at $600. By year 10, the portfolio grows to just over $2,000 and dividend income reaches $100 a year. By year 20, your portfolio value hits the $10,000 mark, and your annual dividend income would be around $1,000. And then comes the exponential part. Fast forward to year 30, and that portfolio would grow into a $132,000 portfolio, paying around $26,000 a year in dividend income. That's over $2,100 a month. $2,100 a month is good, but it's still not the $5,000 per month we're aiming for. So, let's supercharge the portfolio. Let's take it a step further with a plan that adds just $2 a week. That's $100 per year. It's not a huge commitment, and that's the point. This isn't about making drastic changes or cutting your budget. Each week, that $2 adds a little more buying power, a little more compounding, and a lot more future income. Let's look at how it changes the outcome. By the end of year 1, your portfolio will be at $700, and it's generating the same $20 in dividends. But if you keep going, by year 10, that portfolio will grow to around $4,000. That red line of your dividend income starts to curve upward after that. That's the first sign of compounding starting to work for you. Now fast forward to year 20. Your balance will be around $24,000. From the years 20 to 30, everything accelerates. Your portfolio explodes from $24,000 to $312,000, and your dividend income around that time would be $63,000 per year, over $5,200 every single month. Now, let's compare the dividend income of both scenarios. This graph clearly shows the difference between two long-term dividend growth paths, a lower growth strategy and a higher growth strategy, starting from the same point but ending in very different places over 30 years. In year 1, both strategies only generate about $20 in annual dividend growth. That's not much to get excited about, and that's exactly why most people don't realize the power of compounding dividends. But by year 10, things begin to change. The lower growth path is up to around $100 in annual dividend income, while the higher growth strategy has already doubled that, bringing in $200. The compounding effect starts to show itself, not dramatically, but noticeably. Then by year 20, the gap really starts to widen. The lower growth path reaches just over $1,000 in dividends, while the higher growth path has surged to more than $3,000. At this point, it's no longer a small difference. It's a significant gap, and it's only getting wider. By year 30, the difference is huge. The conservative path brings in $26,000 per year, which is great, but the higher growth strategy is generating over $63,000 annually. That's more than $5,000 per month in passive income. If I had to start completely fresh in 2025, wipe out everything I've built, and rebuild from scratch with just 3 ETFs, I'd still feel confident I could retire a millionaire. Why? Because instead of chasing hot stocks or trying to time the market, I'd keep it simple and stick with just 3 ETFs, which I believe cover all the bases you actually need: growth, income, and protection. And that's exactly what I'm going to show you and Josh in this video. The 3 ETFs I'd pick, the reasons behind each one, the 3 core principles, and how they work together to build long-term wealth. In the end, I will show you how the portfolio of these 3 ETFs, with only $9 invested daily, could grow into $1 million nest egg and pay you more than $65,000 a year in dividends. But first, let's clear up the big misconception that trips people up before they even get started. Most people think investing has to be complicated. They picture fast-moving charts, endless research, and chasing the next big stock. No wonder so many give up before they even start. It feels overwhelming. But here's the truth. Building wealth doesn't have to be complicated at all. In fact, the simpler your plan, the better it usually works. The greatest investors of all time, Warren Buffett, Charlie Munger, Jack Bogle, have all preached the same thing. Keep it simple. You don't need to outsmart the market or spend hours reading reports. What you really need is a plan you can stick with through both good years and bad. And here's the secret: consistency beats genius. The person who invests steadily in a low-cost fund month after month usually ends up richer than the one who chases hot stocks or tries to time the market. Complexity feels exciting at first, but it often leads to mistakes. Simplicity may feel boring, but boring is what actually makes you rich. And that brings us to a really important question. If keeping things simple is the way to win, then what's the simplest tool out there that gives you diversification, growth, and peace of mind all in one? For this, we have something called ETFs. Now, let's make sure we're on the same page and understand what exactly an ETF is. ETF stands for Exchange Traded Fund, and the simplest way to think about it is like a basket of investments. Instead of buying just one stock like Apple or Microsoft, you're buying a basket that holds hundreds of different companies all at once. The moment you buy that basket, you own a tiny piece of every company inside it. That means instant diversification, which lowers your risk compared to betting on a single stock. ETFs trade on the stock market just like individual shares, which makes them super easy to buy or sell through any brokerage account. Unlike mutual funds, which only update their price once a day, ETFs update in real time. You can see their value moving minute by minute, just like a stock. The real beauty of ETFs is that they're cheap and efficient. Most ETFs charge expense ratios so low that it costs you just a few dollars per year for every $10,000 invested. Compare that to actively managed mutual funds, which can charge 1 or 2%, hundreds of dollars in fees every single year. And what's crazy is that even with those high fees, most mutual funds underperform the market in the long run. That's why even Warren Buffett, one of the greatest stock pickers of all time, has said that the smartest thing most investors can do is simply buy a low-cost index ETF. His reasoning? You don't have to beat the market, just match it, and you'll already be ahead of the majority of investors. And that's exactly the foundation of the 3 ETFs I'm about to share with you. But before I show them, I want to give you the principles I use to decide which ETFs are worth my money and which ones I skip. Because once you understand these principles, the choices will make complete sense. Because the truth is, it's not just about picking a few tickers and hoping they perform. It's about having a framework, a way of looking at investments that cuts through the noise and keeps you focused on what really matters. Over the years, I've boiled it down to 3 principles. Once you understand these, you'll see exactly why these ETFs I picked fit together so well. The first principle is about dividends. Don't get me wrong, I love dividends as much as anyone, and you'll see in a bit that one of my ETFs leans heavily on them. But here's what most people don't realize. Dividends aren't always as efficient as they seem. Think about it. A company earns money, pays corporate taxes on it, then sends what's left to you. And when that cash hits your account, you pay taxes on it again. That's double taxation. It doesn't make dividends bad, far from it, but it does mean you have to use them wisely. Inside tax-advantaged accounts like an IRA or 401k, they can be amazing, but outside those accounts, they're not the free lunch people sometimes assume. The second principle is consistency over timing. Everyone thinks they can outsmart the market, buy low, sell high, beat the game. But the truth is, even professional investors rarely get it right over and over. That's why I stick with dollar cost averaging. I put money in on a schedule, monthly, quarterly, whatever works. Some months I'll buy at higher prices, other months at lower ones, but over time it averages out. More importantly, it keeps me invested when markets get rough. The third principle is about understanding why some companies and the ETFs that hold them deserve a premium price. It all comes down to returns on capital. Imagine 2 friends each start a lemonade stand with $1,000. One makes 10% on that money every year, so after a year they've got $1,100. The other makes 30%, so after a year they're at $1,300. At first the difference is just a couple $100, not a big deal, but over a decade it compounds into something massive. The 30% lemonade stand reinvests its profits at 3 times the speed, and soon it pulls so far ahead that the 10% company can't even compete. That's why companies like Apple, Microsoft, or certain healthcare innovators often look expensive when you first see their stock price, but they're so good at compounding, at turning each dollar into more dollars, that over time, they can completely run away from the competition. So those are the 3 principles. Be smart about dividends, trust consistency over timing, and value companies that compound at high rates of return. That's the lens I use for every decision. And now that you have that lens too, it's time to apply it and start looking at which ETFs actually deserve a place in this portfolio. In the end, I will show you how the portfolio of the 3 ETFs I selected, with only $9 invested daily, could grow into $1 million nest egg and pay you more than $65,000 a year in dividends. But first, my selection criteria. I have a criteria that I apply before I ever choose an ETF, because not all ETFs are created equal. There are thousands out there, and a lot of them are designed more for marketing than for actually helping investors build wealth. So before I buy anything, I put it through a checklist to make sure it deserves a place in my portfolio. The first thing I look at is history. I want to see how the fund has performed across different market cycles, the booms, the busts, everything in between. Ideally, I want at least a decade of data, because if a fund has only been around for a year or 2, there's no way to know how it holds up when things get tough. The second filter is cost. One of the biggest advantages of ETFs is how cheap they can be, but some funds still sneak in higher expense ratios. I draw the line at 0.25%, 0.25%, and in most cases, I want it to be much lower. The less you pay in fees, the more you keep for yourself, and over decades, that difference can add up to hundreds of thousands of dollars. The third thing I check is diversification. A good ETF should give me exposure across industries and companies, not just concentrate everything in 1 or 2 names. Finally, I look at liquidity and size. I want a fund that's widely traded and has plenty of assets under management. That way I can buy or sell without worrying about getting stuck, and I know the fund is likely to be around for the long run. These are the standards I hold every ETF to, and that's how I selected the 3 ETFs. The first one is what I like to call the dividend workhorse. When I think about building a portfolio that can last decades, Schwab US Dividend Equity ETF with the ticker symbol SCHD is the one ETF that always comes to mind first. SCHD is built around one simple principle: owning high-quality U.S. companies that consistently return cash to shareholders. And when I say high quality, I don't just mean big names. I mean businesses with a track record of profitability, strong balance sheets, and reliable dividends that not only pay out, but also grow over time. Now, SCHD isn't the type of fund that's going to double your money overnight. Over the past year, it's basically been flat, up just about 0.5%. But zoom out to 5 years and you see more than 43% growth. Stretch that out to a decade and the returns are over 124%. That's not as explosive as a tech-heavy ETF, sure, but here's the trade-off. SCHD comes with way less drama. Lower volatility means you can hold it through the ups and downs without losing sleep. And when you're thinking 20 or 30 years ahead, stability matters just as much as growth. Where SCHD really shines is dividends. Right now, the yield is about 3.75%, and it's not just the size of the payouts, it's the consistency. This fund has a track record of growing those payouts every single year. In fact, its 10-year dividend growth rate is around 10.77%. The holdings tell the story too. Companies like Chevron, PepsiCo, and Cisco dominate the top spots. These aren't flashy high-growth names, but they're reliable giants with deep moats. SCHD leans into sectors like consumer defensive, healthcare, and energy, areas that tend to hold up even when the economy wobbles. It's that balance of resilience and steady growth that makes SCHD the bedrock of this portfolio. So while SCHD might not grab headlines with explosive gains, it's the ETF that builds wealth in the background year after year. And once you've got that foundation in place, then you can start layering on something with a little more firepower. That's where the next ETF comes in. QQQ, the growth engine of this portfolio. The Invesco QQQ ETF tracks the NASDAQ 100, which means it's packed with the most innovative and fastest growing companies in the world. It's a direct line into the beating heart of technology and modern business. Companies like Apple, Microsoft, and Nvidia. Looking at the numbers, QQQ has been nothing short of a growth machine. Over the past year, it's been up more than 21%. Stretch that to 5 years, and it's doubled. Look out over a full decade, and it's up a staggering 463%. That's the raw strength of innovation-led investing. Now, QQQ isn't built for dividends. Its yield is tiny, just about 0.5%, so it won't do much for your income today. Instead, its value comes from growth. These are companies that reinvest their profits back into expansion, innovation, and capturing more of the market. And that reinvestment is what drives those incredible long-term returns. Of course, there's a catch. With higher growth comes higher volatility. QQQ moves fast, and sometimes that means sharp drops along the way. Its volatility is significantly higher than SCHD's, which can make the ride a little nerve-wracking if you're checking your portfolio every day. But when you zoom out and focus on decades, not months, those dips become just tiny blips on a long upward trend. That's why QQQ and SCHD balance each other so well. SCHD keeps you grounded with stability and income, while QQQ pushes your wealth higher with explosive growth. It's the yin and yang of investing, safety on one side, opportunity on the other, and together they make a powerful core. But even with both of those in place, there's still one more piece we need to complete the puzzle, a fund that adds stability by reaching beyond US borders. That's where the third ETF comes in. The iShares International Equity Factor ETF is designed to spread your risk beyond US borders, giving you access to global companies that often move differently from American markets. And in investing, diversification is a shield. It protects you when one region stumbles. Over the past year, it's been up about 18.5%. Over 5 and 10 years, the growth has been solid at around 45%. Now, those numbers aren't as jaw-dropping as QQQ's rocket-like growth or as income-heavy as SCHD, but that's not the point. INTF adds stability. It balances things out by giving you exposure across industries and geographies outside of the US. On the income side, INTF quietly pulls its weight. With a dividend yield of 2.78%, it sits between SCHD and QQQ. That means you're still earning a meaningful income while also getting global diversification. The expense ratio is also a lean 0.16%, which keep costs low and ensures more of your returns stay in your pocket. Also, INTF's holdings tell the story. Unlike QQQ's heavy tech tilt or SCHD's dividend-focused mix, INTF spreads itself widely across financials, industrials, healthcare, consumer cyclicals, and even materials. Its top holdings include names like Novartis, ASML, SAP, Nestle, and Royal Bank of Canada. No single company dominates the fund, with the top 10 making up just over 10% of the portfolio. This makes it much less concentrated, which reduces risk from any one company or sector faltering. When you look at risk metrics, INTF stands out as one of the steadier pieces in this trio. Its standard deviation is 11.26, lower than both SCHD and QQQ. Annualized volatility sits at 17.16%, again on the calmer side. This means INTF doesn't swing as wildly during market turbulence, which can be reassuring for long-term investors. In short, INTF doesn't try to be the star of the show. It plays defense, but that role is critical. In a couple of minutes, I will show you how the portfolio of the 3 ETFs I selected, with only $9 invested daily, could grow into $1 million nest egg and pay you more than $65,000 a year in dividends. But first, how do these ETFs work together? When you look at SCHD, QQQ, and INTF individually, each one plays a distinct role. But the real magic happens when you combine them into a single portfolio. Together, they balance one another's strengths and weaknesses, creating a structure that is both resilient and growth-oriented. SCHD brings consistency. Its dividend yield of 3.75% ensures that no matter what the market is doing, you have a steady stream of income flowing in. QQQ, on the other hand, is the growth engine proving itself as one of the strongest vehicles for capital appreciation. INTF then acts as the stabilizer, reducing dependence on U.S. markets and spreading risk across international sectors and companies. What's important here is how these roles overlap and complement one another. SCHD's dividend strength cushions QQQ's volatility. QQQ's explosive growth compensates for SCHD's slower share price appreciation. INTF, with its global diversification, steps in to smooth out market shocks when U.S. equities stumble. From a risk perspective, this mix is also smart. SCHD and INTF keep volatility lower, while QQQ, although riskier, provides the outsized returns that drive wealth building. This trio isn't designed to chase the hottest trend or the biggest short-term gain. It's built to do 3 things at once: grow your wealth, pay you along the way, and protect you when markets get rough. And the best way to see that in action is by looking at the actual portfolio allocation. Here's how I'd break it down. SCHD takes the biggest slice at 40%. With a dividend yield of 3.75%, a 10-year dividend growth rate of around 10.77%, and annual share price appreciation close to 7.84%, it gives you both steady income now and reliable dividend growth for the future. This is your base layer. Right now, SCHD, at 40% of your allocation, offers a current dividend yield of 3.75%, a 10-year dividend growth rate CAGR of 10.77%, and an annual share price appreciation of 7.84%. This makes it both a strong source of immediate income and a reliable driver of future dividend growth. Then we've got INTF at 30%. Its dividend yield is about 2.78%, but what really stands out is its dividend growth over the past decade, nearly 19.4% a year. Price appreciation has been more modest at about 3.9% annually, but that's not its job. Finally, QQQ rounds things out with the last 30%. Dividends here are basically an afterthought at just 0.49%, but that's not why you own it. Its strength is pure growth, with an average annual price appreciation of nearly 18% over the past decade. When combined, the portfolio as a whole stands at a 100% allocation with a weighted current dividend yield of 2.48%, a weighted 10-year dividend growth CAGR of 13%, and an annual share price appreciation of 9.67%. This mix means you're positioned with a balance of steady income and strong growth. And to really understand how powerful that combination can be, let's look at what it means for your wealth if you stick with it over the long run. Say you start with a daily contribution of $9. At first, it doesn't look like much. After the first year, your account balance is pretty much just what you put in, and that is $3,285. By year 10, though, things start to take shape. Your balance will grow to about $60,000 and dividends will be at roughly $2,000 a year. Fast forward to year 20, the portfolio will be valued at around $278,000 with dividends of about $11,000 every year. But it's at year 30 that the strength of compounding really shows up. By then, the portfolio pushes past $1.2 million and the dividends alone rise to about $67,000 a year, more than $5,500 every single month. If you had just $10 a day to invest in the S&P 500, how long do you think it would take to reach $2,900 a month in dividends? 10 years? 20? Maybe 30? Well, if you stick to the traditional path, it's going to take over 60 years to hit that target. That's the reality for most investors, slow and painfully long. But what if there's another way, a faster path to that same income goal without needing millions and 3 or 4 times faster? This video is all about that. I'll walk you and Josh through the numbers, why the standard S&P 500 can't get you there, the solution to that problem, the perfect portfolio built for this exact target, the specific stock picks, and in the end, I'll show you how this portfolio with only $10 daily investments gets you to $2,900 a month 3 times faster than the S&P 500. And then the $30 daily gets you there more than 4 times faster. But before we get into the how, let's first get clear on the goal and what it really takes to reach it. So here's the goal, pulling in $2,900 a month from dividends. That adds up to $34,800 a year, which for a lot of people can cover rent, food, bills, and still leave room for some freedom. So how much would you need to invest to make that happen? The math's pretty straightforward. You take your yearly income target and divide it by your portfolio's average dividend yield. For example, with a 3% yield, you'd need around $1.16 million invested to earn that $34,800. That's what you're looking at with most blue-chip dividend stocks. Stable, but requiring a big chunk of money up front. Now, if you raise that yield to 4%, the required investment drops to roughly $870,000. Increase it again to 5%, and now you're talking about needing $696,000 to hit that same annual income. In other words, just by targeting a slightly higher yield, you would need less than 2/3 of the capital required at 3%. The challenge, of course, is that most people aren't starting with $700,000 ready to invest. Even if they were, they'd want that income to grow over time to keep pace with inflation. That's where dividend growth and reinvestment, often called DRIP or Dividend Reinvestment Plan, become game changers. Say you put $100,000 into a stock priced at $10 a share. That gives you 10,000 shares right off the bat. With a 5% dividend yield, you're earning $5,000 in that first year. Instead of spending it, you reinvest those dividends and buy another 500 shares. Now you're holding 10,500 shares. Year 2, those 10,500 shares pay you a little more, about $5,250. You reinvest again, which adds another 525 shares. By the end of year 2, you've got 11,025 shares working for you. Fast forward to year 3, and your dividends are now $5,512. Reinvest that, and you pick up another 551 shares. That brings your total to 11,576 shares. See what's happening? You didn't add a single extra dollar of your own money, but your dividend checks are growing every year, and the number of shares you own keeps climbing. That's compounding at work, like a snowball that starts small, but gets bigger and faster the longer it rolls. You don't need $100,000 to make this work. You can start with as little as $10 a day. That's the price of a sandwich and coffee, but when you consistently invest it and let those dividends roll back in, the snowball starts building the same way. Now, let's see what happens when you try to reach $2,900 a month using just an S&P 500 ETF. When most people think about investing for the future, the first piece of advice they hear is just put your money into an S&P 500 index fund and leave it there. And to be fair, that advice isn't wrong. The S&P 500, whether through ETFs like VOO or SPY, has a decades-long track record of delivering solid total returns, steady growth, and broad diversification. You're essentially buying a slice of 500 of the biggest and most successful companies in America. But if your goal is to create income you can actually live on, the S&P 500 has one big problem. It doesn't pay much. Right now, the dividend yield is 2.5%, and that's me being very generous. It has a dividend growth rate of 6% and an annual share price appreciation of 11%. Let's walk through this with a $10 a day example. In the first year, you've only saved about $3,650. Not much income yet, but you reinvest everything and let compounding start to work. Fast forward 10 years, and your portfolio might be worth around $67,000, paying about $1,000 a year in dividends. That's progress, but still nowhere near something you can live on. And here's the reality check. To reach the target of $2,900 a month, or about $35,000 a year, you'd have to keep contributing and reinvesting for more than 6 decades. To be exact, 66 years. That's a lifetime of waiting before your dividends finally catch up. The real takeaway here is the shape of that income curve. Compounding always looks exponential. It crawls along slowly at first, almost flat, and then shoots upward later. And with the S&P 500's low yield, most of that exciting growth happens way too late. By the time the dividends finally reach a livable level, decades have already passed. Now, if your only goal is to grow your net worth, that's fine. The S&P has been incredible for long-term total returns. Now, if you're investing for income, money you can actually use while you retire, it's frustrating. You want those dividends to matter sooner so they can be reinvested, snowball faster, and actually change your lifestyle in the near future, not just when you're 80 or 90. This is why simply copying the S&P 500 isn't the fastest road to financial independence through dividends. The income engine is too small in the beginning, and that slow start costs you precious years. So the alternative is to build a portfolio that starts with a higher yield, but a safe yield, combines it with strong dividend growth, and still delivers healthy capital appreciation. That way, you're not waiting 60 years to see meaningful income. Instead, you can shift the compounding curve forward so the big growth years happen in the first 2 decades, not the last 2. In just a couple of minutes, I'll show you the exact portfolio, and at the end, I'll show you how this portfolio with only $10 daily investments gets you to $2,900 a month 3 times faster than the S&P 500, and then the $30 daily gets you there more than 4 times faster. So, how do you build a portfolio that actually reaches the target faster? It all comes down to picking the right kind of stocks, and that's exactly what we're going to get into next. If the S&P 500 is too slow for building a meaningful income stream, the obvious question becomes, what kind of stocks will get us there faster without taking reckless risks? And here's the first mistake beginners usually make: chasing the highest dividend yield they can find. That looks good on the surface, but it's a trap. The goal isn't to grab the biggest number. It's to find that sweet spot where yield, growth, and stability all work together to build income you can actually count on. For me, that means starting with a yield that's noticeable but not suspicious. Somewhere in the 3 to 5% range is usually the sweet spot. If you see double-digit yields, that's often a red flag that something's wrong with the company, and those dividends may not even last. Then you want growth. I don't want a company that pays the same check forever. The best dividend stocks are the ones that raise their payouts year after year, ideally for a decade or more. That growth not only beats inflation, but when you reinvest it, the compounding snowball gets even bigger. Then there's the payout ratio, the percentage of earnings a company distributes as dividends. If a company is paying out 90% or more, there's little room for error if profits fall. A payout ratio under 70% is generally a sign that the dividend is sustainable and has room to grow. And of course, the company's overall health matters. Strong balance sheets, steady cash flow, and a profitable business model mean they can keep paying you even when times get tough. Finally, diversification is your safety net. No matter how strong a stock looks on paper, there's always risk. By spreading your investments across different sectors, like technology, healthcare, real estate, and consumer goods, you protect your income from being too dependent on one industry's fortunes. When you put all these factors together, you get a portfolio designed to grow both in size and in income while keeping risk under control. And now that we know what to look for, let me show you the exact stocks I've built into my dividend growth portfolio and why they fit these rules so well. The first cornerstone is the Schwab US Dividend Equity ETF with a ticker symbol SCHD. With a yield of 3.81%, a 10-year dividend growth rate of 10.77%, and annual share price appreciation of 7.62%, SCHD offers a diversified foundation of high-quality dividend-paying companies. It's reliable, well-balanced, and an ideal starting point for income-focused investors. Then we add AbbVie, ticker ABBV. This healthcare giant has a 3.31% yield and has been raising its dividend at an impressive 12.66% a year. On top of that, the stock's grown by 11.19% annually. Healthcare is defensive. People need it no matter what, so AbbVie gives the portfolio both stability and steady income. On the real estate side, I like CubeSmart, ticker CUBE. It focuses on self-storage, and yes, storage units may not sound exciting, but they pay. Cube's yield is 5.36%. Its dividend has been growing 13% a year, and even the stock price has ticked up 3.91% annually. This is the income booster in the mix. Then there's Federal Agricultural Mortgage with a ticker symbol AGM. This niche financial company serves the agricultural sector and has been a powerhouse for dividend growth. 25.47% annually over the past decade with a 3.38% yield and a remarkable 18.61% annual price appreciation. It's a perfect example of how high growth can supercharge future income. Finally, I've selected Interparfums with a ticker symbol IPAR. While its yield is lower at 2.76%, The 10-year dividend growth rate is a strong 20.26%, and annual appreciation is 14.04%. IPAR's high growth rate makes it a future income star, even if the yield starts small. The next step is to figure out your portfolio metrics, and it's fairly simple. Let's start with dividend yield. Think of it like averaging test scores. You just take the yield from each stock, SCHD at 3.81%, AbbVie at 3.31%, Cube at 5.36%, AGM at 3.38%, and IPAR at 2.76%. Add them all up, and you get 18.62. Then divide that by 5, the number of stocks in the portfolio. The answer is 3.72%. That's your portfolio's average dividend yield. And you can use that same simple math for other things too, like dividend growth and share price appreciation. Add up each stock's percentage, divide by the number of stocks, and you've got your portfolio's average growth rate. For this portfolio, here's what it looks like. An average dividend yield of 3.72%, dividend growth of 16.43%, and share price appreciation of 11.07% a year. That combination gives you a strong foundation of income today, rapid growth for tomorrow, and solid long-term wealth building all at once. Now let's look at exactly how this portfolio's value grows over time and how quickly it can take you and Josh to that $2,900 per month target. With this portfolio, after 1 year, you'd have invested about $3,650. Stick with the $10 a day strategy, and by year 5, your annual dividends would be roughly $1,000, with your portfolio sitting at $25,000. By year 10, the pace picks up. Dividends rise to about $4,000 a year, and the portfolio grows to around $79,000, enough to cover a month's rent or a few major bills. Then comes the tipping point. By year 15, dividends jump to about $13,000, and the portfolio passes $207,000. Finally, by year 19, you hit the goal, around $35,000 a year in dividends, just over $2,900 per month, with a portfolio worth about $447,000. When you put this dividend-focused portfolio side by side with the S&P 500, the difference in speed is hard to ignore. Both start from the same place, $0 in annual dividends, but the paths they take couldn't be more different. With this portfolio, your dividend income rises fast, hitting about $35,000 a year by year 19. That's the $2,900 a month target in less than 2 decades. From there, the curve is steep and still climbing, which means even bigger payouts in the years ahead. Now compare that to the S&P 500. Same starting point, but the income crawl is painfully slow. Even with all that compounding, it doesn't reach the same $35,000 a year until year 66. That's almost 50 years longer to end up in the same place. Now, that comparison alone shows you why the dividend growth portfolio is so powerful. But here's the question, what if you wanted to get there even faster? So far, we've been looking at a simple $10 a day strategy, but if you double that to $20 a day, the results change completely. By year 5, you'd already be pulling in around $2,000 a year in dividends with a portfolio worth about $50,000. By year 10, it'll be worth around $157,000, paying around $8,000 in dividend income. By year 16, you're closing in on $34,000 in annual dividends. Basically, the $2,900 a month target, with a portfolio around $500,000. And if you push to $30 a day, the snowball would reach the target somewhere around 14.5 or 15 years. Around that mark, the portfolio would be valued around $620,000, paying roughly $40,000 a year. So here's how it boils down. With $30 a day, you hit the goal at year 15. With $20 a day, it takes just 1 year longer, year 16. With $10 a day, you still get there, but it's at year 19. So the more you put in daily, the faster the snowball builds. But the amazing part is, even with just $10 a day, you're still there in under 2 decades. Now, look at the other end of the line. If you were only investing in the S&P 500, you wouldn't hit that same $35,000 in annual dividend income until year 66. That's almost an entire lifetime later than the custom dividend portfolio. One single ETF shifted 19.58% of its portfolio, not into tech, not into crypto, but into the one sector that just got full government backing under Trump's new $4.5 trillion Big Beautiful Bill. This shift told us exactly where the next big money is headed. And in this video, I'm going to break down exactly what's inside Trump's Big Beautiful Bill, how it's benefiting entire sectors, and the dividend ETFs that shifted their positions to reap the most reward. In the end, I'll show you and Josh how the ETF benefiting most from the bill could turn a $7 daily investment into a $1 million portfolio and pay over $7,000 per month in dividend income. But first, let's have a look at the bill that changed everything. Let's break down what's actually inside Trump's 2025 Big Beautiful Bill, because this isn't just another round of tax cuts. It's a full-blown economic reset that reshapes the rules of the game for dividend investors. The headline move is making the 2017 tax cuts permanent. That means lower personal income tax rates stay in place, and corporate tax rates remain at 21% instead of jumping back up. For companies, that's predictable long-term tax savings, and predictable profits are exactly what dividend investors want. Then there's the overhaul of business deductions. The pass-through deduction jumps from 20% to 23%, which means more profit retained by small and mid-sized businesses. Section 179 expensing limits doubled from $1.25 million to $2.5 million. In plain English, that means a business can buy equipment, machinery, or upgrades and write off the full cost in the same year, instead of spreading it out over several years. This encourages companies to spend more now, which often leads to faster growth and higher earnings. On top of that, 100% bonus depreciation is back. Companies can instantly deduct the full cost of big investments, like factories, large vehicles, or major upgrades, instead of waiting years to recover the cost through depreciation. Then there's the most targeted part of the bill. It clearly picks winners and losers. Oil and gas companies are getting fast-track permits and regulatory rollbacks. Renewable energy subsidies from the 2022 Inflation Reduction Act are removed, shifting the playing field away from green energy. Defense spending jumped sharply, with billions earmarked for missile systems, border technology, and military contracts. Infrastructure projects get a $12.5 billion boost, with specific upgrades like air traffic control modernization. In short, the bill rewards capital-heavy industries that can absorb large investments, generate big profits, and pay steady or growing dividends. If your ETF is overweight in these areas, you're positioned to benefit directly from the policy tailwinds. If not, you're likely to miss much of the upside. And one of them, just one, made that move before the bill passed. It rebalanced, refocused, and repositioned at the perfect time. Right now, most investors are celebrating the wrong thing. They see the headlines, tax cuts, more take-home pay, a consumer boost, and they assume this rising tide will lift all boats. But here's the truth. Not every stock benefits equally, and not every dividend ETF is built to capture what's really going on underneath. The problem is that many portfolios are still built for the last cycle. They're heavy in utilities, real estate, and big tech sectors that thrived in the low-rate post-pandemic environment. But rates are higher now, government spending priorities have shifted, and the industries with the strongest tailwinds are completely different. And that's the part people miss. This bill isn't designed to help the market. It's written to reward specific behavior. If your fund doesn't hold companies that are investing, expanding, and building within those favored sectors, you could be on the sidelines for the next phase of dividend growth. Meanwhile, the few ETFs that got this right are quietly pulling ahead. They adjusted, they reallocated into energy, defense, and consumer staples before the crowd, and now they're positioned to collect stronger profits and more consistent income for years to come. Most investors won't realize they've missed it until they see other people's portfolios growing faster, paying more income, and outperforming without taking extra risk. And by then, it'll be too late to reposition without chasing the rally. Which is why right now, before the rest of the market catches on, is the time to take a hard look at what you own. Because there's one ETF that's already made the shift, and once you see which one it is, the strategy becomes a lot clearer. So what is smart money doing right now? Let's be honest, retail investors are usually late. But if you want to know where the market is going, you follow the money. And right now, smart money is quietly shifting toward the sectors this bill just supercharged. Institutional investors, hedge funds, pension managers, and billion-dollar family offices are making moves that aren't obvious unless you know where to look. One of the clearest signals? Recent 13F filings. We're seeing increased allocations to energy giants, defense contractors, and even industrial names. ETF flow data backs it up too. Since March, dividend-focused ETFs with high exposure to energy, industrials, and defense have seen a surge in institutional inflows. It's not enough to make front-page news, but the moves are deliberate. So the question is, which ETF is set up to benefit the most? Let's start with JEPI, the JP Morgan Equity Premium Income ETF. On the surface, JEPI looks like a winner. It's got a high yield, pays monthly, and has a reputation for stability. That's appealing to anyone chasing steady income. But when you step back and look at it through the lens of the 2025 tax bill, some cracks start to show. First, the performance. Over the past year, JEPI has returned just 2.18% and only 5.21% over 5 years. Compared to SCHD or VYM, that's sluggish. This underperformance is partly due to its strategy. It generates income by selling covered calls, not from dividend growth or capital appreciation. That strategy works best in sideways or volatile markets, but the tax bill is pushing the market into a long-term directional trend, one JEPI isn't built to ride. Its sector breakdown is also misaligned with policy tailwinds. JEPI has just 2.73% in energy, the sector that's expected to thrive under the new tax incentives. It's also light on industrials and lacks the deep exposure to dividend growth leaders in financials and defense. Instead, its top holdings are mostly mega-cap tech and consumer brands like Meta, Microsoft, Oracle, and Nvidia. These are strong companies, but they're not the ones most levered to the post-tax bill boom. And then there's the way the fund is structured. JEPI owns 127 different companies, but only about 16% of its assets sit in its top 10 holdings. That's a sign of very broad diversification, which can help smooth out volatility, but it also means any high-conviction bets get diluted. When the market is shifting hard in favor of certain sectors, spreading yourself thin can slow you down. JEPI's 8.65% yield is tempting, and for short-term income seekers, it has a role. But in this new sector-specific investing environment, JEPI is more of a placeholder than a powerhouse. That's why it is likely not to get the new bill perks. In the end, I'll show you and Josh the ETF most benefiting from the bill and how it could turn a $7 daily investment into a $1 million portfolio and pay over $7,000 per month in dividend income. Next up is DGRO, the iShares Core Dividend Growth ETF. This is the classic safe pick. It's low cost, widely held, and built on a disciplined dividend growth strategy that favors long-term stability over flash. Over the past 10 years, it's returned an impressive 146.58%. Over 5 years, it's grown by 63.4%. And in the last year alone, it's up 12.21%. These are strong numbers, but in the current market, where tax policy is accelerating certain sectors, strong might not be strong enough. DGRO's dividend yield sits at 2.21% with a trailing 12-month dividend rate of $1.42. Dividends are paid quarterly, and its growth is healthy, but not aggressive. What's holding DGRO back is its broad, balanced exposure. It's trying to cover everything, and in doing so, it misses the opportunity to concentrate on the areas now benefiting the most from the new tax laws, like industrials and energy. Its sector exposure tells the story: 20.02% financials, 19.09% tech, 16.52% healthcare, 11.35% consumer defensive. Industrial and energy, just 10.6% and 5.33% respectively. Real estate and utilities are almost 7% combined. These are not the weightings of an ETF positioned to surge from capital expenditure tax breaks or depreciation incentives. The top 10 holdings are familiar giants: Microsoft, JP Morgan, Johnson & Johnson, Exxon, Broadcom, Apple, AbbVie, Home Depot, Procter & Gamble, and Merck. Together, they make up 27.45% of the fund. These are quality companies, but most of them are mature and not significantly leveraged to new industrial growth or infrastructure expansion. That means less upside from the current macro tailwinds. In this policy-driven environment, DGRO doesn't do anything wrong, but it doesn't do enough right either. Reliable, yes. Optimized, not quite. That means it might not be the gold mine ETF you're looking for. Next up is the Vanguard High Dividend Yield Index Fund ETF share. With a ticker symbol of VYM, this is the definition of solid. It's diversified, cheap to own, and performs consistently. With $75.6 billion in assets under management, it's a heavyweight in high dividend investing. Over the past year, it's returned 14.05%, followed by 63.57% over 5 years and 97.75% over 10 years. These aren't jaw-dropping gains, but they are undeniably dependable. Its 2.65% yield and $3.53 dividend rate come with quarterly payouts, and it has an ultra-low expense ratio of just 0.06%. That means more money stays invested instead of going to fees. Investors love that efficiency. Meanwhile, VYM's top holdings read like a checklist of blue-chip giants: Broadcom, JP Morgan Chase, ExxonMobil, Walmart, and Procter & Gamble. It holds 585 total stocks, with 25.42% of assets concentrated in its top 10 names. That's tight enough for conviction, but broad enough for stability. Looking at sectors, financials lead at 21.65%, followed by tech at 15.96%, healthcare at 12.49%, and energy at 8.31%. Utilities and real estate sit lower at 5.85% and 0.02%, which matters when evaluating VYM in this new tax-optimized world. So how does VYM benefit from the new tax law? Modestly. Its exposure to energy, 8.31%, and big banks like JP Morgan positions it to capture some upside, but its relatively muted exposure to industrials and heavy allocation to other sectors limit its breakout potential. It doesn't quite align with the sectors most favored by the new policies. That's why it lands at the number 2 spot. It's a rock-solid ETF, the kind you want in your core portfolio, but in a sector-specific, policy-driven environment, solid isn't quite enough to win. Now let's see how SCHD, the Schwab US Dividend Equity ETF, handles the new bill. With $69.32 billion in assets and a razor-thin 0.06% expense ratio, this ETF is lean, efficient, and built to deliver both income and growth. Now, in a volatile year, SCHD has held firm, returning 44.06% over 5 years and a solid plus 107% across the last decade. Its top holdings are powerhouses of dividend consistency and financial strength: Chevron, ConocoPhillips, PepsiCo, Cisco, AbbVie, Altria, Amgen, Merck, Home Depot, and Verizon, collectively making up 41.25% of the fund. It's concentrated, and that's intentional. SCHD favors quality over quantity, investing only in high-quality companies with consistent cash flow, strong return on equity, and a solid history of paying and growing dividends. Sector-wise, it's stacked exactly where the new bill is sending the most momentum. The 2025 Big Beautiful Bill directs money and tax breaks towards specific industries, and SCHD is heavily weighted in those areas. Energy gets deregulation, faster permits, and new tax incentives. In March, SCHD nearly doubled its energy exposure from about 12% to roughly 20%, making it the largest sector in the fund. Top holdings like Chevron and ConocoPhillips can expand production, secure long-term contracts, and push higher profits into dividends. Industrials benefit from expanded expensing limits and 100% bonus depreciation, which allow immediate write-offs for major upgrades and expansions. SCHD holds about 10% in industrial leaders positioned to gain from this investment cycle. Defense spending increases also feed into several SCHD holdings tied to military contracts through industrial and tech operations. Over 1/3 of the portfolio is in consumer defensive and healthcare, providing steady dividend growth regardless of market conditions. SCHD avoids utilities and real estate almost entirely, steering clear of sectors unlikely to benefit from the new policy. In this post-tax reform market, where sector exposure and domestic strength drive returns, SCHD is positioned to take full advantage. Its focused methodology, powerful sector tilt, and rock-solid dividend credentials make it not only the best-performing ETF in this list, but also the one best aligned with where markets are headed next. Now that we've found our gold mine, the next question is simple. How much could SCHD actually return over the next 10, 20, or 30 years if Josh invests just $7 a day? SCHD's current numbers are strong: a 3.89% dividend yield, 10.77% average dividend growth over the last decade, and 10.77% annual share price appreciation. Which, seeing how it ended up on the good side of the Big Beautiful Bill, is solid to say it will likely be able to maintain these metrics. If you contribute $7 into SCHD every day, by the end of the first year, you would have invested $2,555. This sets the stage for future growth. By year 10, the account will grow to around $45,000, generating about $2,000 a year in dividends. This growth is still relatively modest, but it lays the foundation for significant acceleration later. By year 20, your portfolio will grow substantially to about $214,000, and your dividend income will be roughly $13,000 annually. The most dramatic growth happens between the years 20 and 30. By the end of year 30, your portfolio reaches approximately $1,004,000, and your dividend income reaches $84,000 per year. That's nearly $7,000 per month. This level of passive income could support or even replace a full-time salary, marking a transition to financial independence. And that wraps up this compilation of the best strategies to live off dividends. Whether it's one ETF, a simple portfolio mix, or maximizing compounding, You now have a blueprint to grow your money into a true income stream. The key is consistency. Invest, reinvest, and let time do the heavy lifting. Thanks so much for watching, and if you've got value from this, make sure to like, subscribe, and join me in the next video, where we keep building financial freedom step by step.